GETCRACK. Wake up, motherfucker.
Pricing markets, we'd have a trader on the desk who was adjusting spreads to try, capture more flow, make sure the client experience is the best it could be, keep it as tight as possible, but within the constraints of the market. And that was a very time-consuming job. They had to constantly be monitoring, constantly be doing this. But at ING, we've always tried to be innovative and be one step ahead of the market. And in this, we were looking, how can we do this better? What sort of methods can we use? And with this, we looked at an AI model. So over the last few months, we started to develop this model. And what we found was this model could really just outperform the human. It was better at predicting the market, not predicting, so adjusting the spreads. And maybe if you remember the AlphaGo model, where a few years ago now, it was the experts were astounded when it found sort of strategies that the humans had never found. And we found this with this model. It was adjusting spreads in ways we'd have never done as humans.
That's interesting. You did it though by hiring a human machine programmer. Talk to us about his work, because creating that AI model and how you program it is kind of the secret to the success, isn't it?
Yeah, of course. In AI, I mean, it is still human driven. AI is not creating AI. It's not machines creating machines. So again, in this case, we were thinking, where's the market going to go? How do we hire? And we've seen this over the last 20 years in FX, as the market's changed from very traditional voice traders, and slowly at the start we saw quants start to get onto the desk. We saw sort of very good developers start to drift onto FX desks. And then over the last few years, we've really seen it accelerate. The sort of shift in skill set has gone from the traditional voice trade to sort of quants and developers. And now we thought, well, okay, what's the sort of next evolution in that step? And that's where we thought AI, that's the next thing. So we went to the market, we hired AI specialist, and his first, well, you always just come in and go, there you go, make things better. So we sort of gave him a task. It wasn't, we didn't tell him what to do. We sort of gave him free rein and said, come up with a new great idea, and that's what he did.
So Simon, it's proving effective when it comes to FX. Do you oversee a broader asset mix than FX? So are you looking to deploy this with other asset classes? Fixed income, is that in your sights? Equities? How are you thinking about expanding the scope of this?
Yeah, I mean that's a really good question. So over the last few years, ING's gone through this amazing sort of digitization project, and what we found is like each asset class was very siloed. So we got to the end of that and we started to look, how do we take this the next step? So sort of the next, again, to use the word evolution of the sort of digitization, we've said, okay, how do we then take the best in class from each asset class, the best tech, the best ideas, the best sort of algos, can we use those across asset? And so we created this idea of a cross asset group, and this is literally just happened a few weeks ago, and this is a perfect example of where we can take this model, which has been trained on FX, is very specific to FX, but the underlying idea is not FX specific, and we can move it to different assets. So you mentioned FI. I think credit will be one of the first ones we'll look at doing. The sort of price construction, how we create a price is very similar there. So it's not quite lift and shift, but it's
does that happen this year, or is it a longer time?
I think this year we'll start it. The training may.
This Halloween, it's time to turn up the heat and bring those spooky vibes. The John Galt YouTube channel is hosting the ultimate sexy Halloween costume contest, and you could win over $300 in cash. That's right, first place takes home the biggest prize. But don't worry, second and third place will still score big. It's easy to enter. Dress to impress, flaunt your most creative, sexy, or daring costume, and show up to the live stream during the evening of October 31st, which is a Thursday. Come on over on Halloween and flaunt your very best and enter your chance to win the grand prize. Let your imagination run wild. You can be a witch, a vampire, a ghost, a nurse, a cheerleader, anything goes. The more unique and bold, the better. Winners will be crowned based on creativity, style, and those spooky Halloween vibes. The John Galt community will decide who takes home the glory. So what are you waiting for? Get your costumes ready now and come on over to win that prize on the John Galt YouTube channel. Hit that subscribe button, follow the contest rules, and you could be walking away with cash and bragging rights. This Halloween is not just about tricks and treats, it's about winning big on the YouTube channel, The Urban Landlord. It's the only place doing this. Let's have some fun, let's have some laughs, and let's have a spooky
Most read stories on Bloomberg in the last 24 hours. There's no surprise about that. It has all of the facets of a story that would, just engage our audience on Bloomberg technology. Let's get specifics. Why only 5% of jobs, and which sectors and industries are you basing your thesis on?
Well, thanks, Ed. It's great to be on the program. I think right now there is a lot of potential, excitement, perhaps hype about AI. But if you look at its current capabilities, we are very far from AI, either generative AI or other types of AI, performing any of the tasks that involve a heavy level of interaction with the physical world. Construction work, manufacturing work, carpentry. Those, perhaps one day, will be much more feasible, for example, if AI becomes so much more advanced, so much more reliable, and can be integrated with so much better robots, for instance. But it's not something that's going to happen in the next 5 or 10 years. Now, there's a lot of other potential for future AI, perhaps to perform some social tasks. But those are not going to be possible right now either. You're not going to go to an AI psychiatrist anytime soon. So if you sort of strip out all of these, you're not going to be left with much more than 5% of the economy.
Professor, may I jump in and push back with a point raised by our audience when I said you were coming on, which is that AI technology is exponential, much in the way that the invention of electricity with time led to all sorts of breakthroughs. Right now, you're saying 5% of jobs, but in 2 years or 5 years from now, would you need to rethink your thesis or redo your calculations?
I should have prefaced this by saying there's a huge amount of uncertainty in any forecasts about AI, and apologies that I didn't do that. I try to do that all the time. I was very excited. I just jumped into it. There's a huge amount of uncertainty, and one source of uncertainty is exactly what's going to happen with AI in the next several years. I don't think that the most optimistic views in the industry, which sometimes people refer to as scaling laws, actually will hold water when you look at it within the next 5 years or 10 years, which say, just double the amount of data, double the amount of compute power, and then you're going to get double the amount of capabilities. Because to do that, we would actually need higher quality data. So if you want AI to do the job of a carpenter, you really need a completely different kettle of fish when it comes to the kinds of data. And something like that might be feasible with a different architecture of AI, but right now, all of the money is going into the sort of the basic dominant architecture, which has its limitations, both in terms of reliability, in terms of high-level reasoning. So that's the basis of my belief that, of course, generative AI and other types of AI will improve, but we're not going to see a qualitative jump within the next 5 to 10 years.
Professor, your belief, what is exactly it based on? What data, what historical norms are you looking back on to drive and push forward on this 5% take?
Yeah, I think this is why there is so much uncertainty. There's nothing that's identical to generative AI in the past. And that's part of the reason why people can hold very different beliefs. But what I'm basing that on is, first of all, other waves of digital technologies that promised a lot of automation, sometimes a lot of productivity improvements, sometimes a lot of changes in the way that we would organize our offices and things like that. And at the end, all of those changes have been very gradual. And also what we have seen over the last 2.5 years, where, there have been advances, but the advances haven't really been sort of qualitative in nature. They haven't really exceeded the sort of the basic capabilities of GPT 3.5 or GPT-4. So there will be advances, but I don't think any of those advances will very quickly change the way that we do various tasks in the economy. So, for example, I do not believe that in 5 years' time, when we look at the labor market, we're going to see certain occupations that will have completely disappeared.
But many would say, Professor, that they would be augmented. The idea is, perhaps the optimist view is, we will not lose lots of people from the labor force, but their productivity will be scaled. When you look
think
at...
that's yes.
No, please.
I think that's a very, very interesting and important point. I am not an AI denier or an AI pessimist. I actually believe AI has a lot of potential. And in fact, the real potential is exactly what you said, Caroline, which is that AI becomes a tool for workers to boost their productivity. And again, we're seeing some of that happening. Microsoft has a lot of co-pilots, some of them work, and they give some productivity improvements. There are a few areas where we're seeing really phenomenal improvements. Like, for example, if you want to write simple subroutines in one of the common programming languages, GPT-4 is great. Before then, GitHub Copilot was pretty good. So there are some things in which that sort of help to decision makers is possible. But again, when you look at the whole economy, that means helping carpenters, electricians, plumbers, blue-collar workers, construction workers, transport workers, people who are doing teaching, people who are doing journalism. Those are things that could be achieved perhaps at some point, but the reliability and the reasoning of the models is not up to the task yet.
Do you see specific...
How dire of a situation is it for Boeing where they're resorting to job cuts at this moment with a strike still ongoing?
Good morning. Yeah, it's a pretty risky strategy that you're sort of throwing these 17,000 job cuts, 10%, into the middle of an already messy strike. Obviously not something that is looked upon favorably by the unions and the workers. They see this as a threat. Boeing basically trying to some degree, negotiate in public here, saying we might not need all these people who are striking, and business is such that we have to make some tough decisions. We don't know at this point exactly where the hammer will fall. We don't know who will get cut. The company did say on Friday that management, executives and workers will equally be affected. So there's a sort of a sense of solidarity and sort of common purpose in this. But at the same time, we don't know how much it'll cost. We don't know how long it'll take. So the sort of financials tied into these measures, that's the part that remains unclear. Boeing is due to report earnings on the 23rd of October, so middle of next week, and hopefully we'll find out a little bit more then. But for the time,
something like this was coming. Of course, you had plenty in the analyst community saying that they need to do some sort of equity raise here. Talk us through this $25 billion shelf, though, and what we know so far.
Sure. So a shelf filing is really sort of a precursor to raising any kind of equity, and it can be a mix, actually, of stocks or bonds. Although in Boeing's case, they're more likely to issue, lean heavily on stock issuance, just because their debt is sort of teetering at that precipice of junk, and they're very much trying to avoid that. You had both S&P and Moody's now warning that they are reviewing Boeing's credit for a potential downgrade in junk. That would make the company the biggest so-called fallen angel ever, really. And it would obviously increase Boeing's cost at a time that they can ill afford more expenses. So this was not unexpected, and this is really sort of a lifeline for and something that they need to consider, not just to get through this current cash crunch that they're facing while they deal with a labor strike and slower production of the 737 MAX before that because of the issue that happened back in January with that blown out door and extra scrutiny from the FAA. But then also looking forward, Boeing needs to also think about the future. They need to think about a clean sheet replacement for that 737 aircraft eventually if they want to continue to compete with Airbus. And so for Boeing to think about that future, to have that future, they really do need to be thinking about some sort of financial lifeline here.
But of course they can't fail, right, Brooke? Because airlines want to have more than one plane maker, and the U.S. also wants to have its own. Plus, there's only one other, really.
Absolutely. And I mean, the reason why we're sort of in this position to some extent is because there was so much consolidation in the aerospace manufacturing industry in the U.S. And you are right. Boeing is really the only viable maker of large aircraft in the U.S. It is a national champion. It is a major defense contractor. So it is not an option for this company to fail. And the U.S. government cannot let that happen. So there is that backstop there. But that, there are shades of in between there, between a company falling into
Hello, guys. Welcome. It's about 12 hours past when I tried to schedule this, but hey,
junk status and getting
getting somewhere here. And I think I gave you some mixture of news. Boeing announced cuts Friday after the close. And, that's interesting timing. I think we can look at the chart for Boeing. Might be something you might consider to buy now that it's getting the worst type of news possible. It's going to issue more stock, as you heard. Let's see where we are. Yeah, so this is a 65-minute chart. It's still hovering in this 150 area. Yeah, it hasn't been doing much for quite some time. So since COVID, yeah, it likes to tend to drop down here, huh? To this 120. Okay. Yeah, I'll put this on the watch. Add this to Intel, companies that are big, doing a terrible job managing costs, terrible corporate culture. Yes, so this area here between 105 and 152. Let's see what happens. Never know. Might get lucky. Might get a nice drop, and we could just pick it up. Looking at this MACD line here is falling over, so yeah, that's not a good look. Definitely looks ready to collapse. So we'll have earnings soon, next week, as you heard as well. So I'll continue on. Let's show some video here about the corporate culture. See what it gotta be changed before this thing is a turnaround story. It might take a while.
Shares of Boeing, they're actually up 1% this morning. The company said it's going to add a short-term credit agreement worth $10 billion with a consortium of banks, including Bank of America, Goldman Sachs, JP Morgan, and Citigroup. Meanwhile, the company also filed a registration statement with the U.S. Markets regulator for a securities and stock sale of up to $25 billion. Meanwhile, Boeing CEO Kelly Ortberg facing several major challenges just a month after 30,000 machinists walked off the job. Our next guest says Ortberg has a unique chance to repair the damage. Joining us now, Gautam Mukunda is a professor of management practice at the Yale School of Management. And explain, how is this, it sounds good, I love silver linings, but how is this a possible positive for the company and the CEO? Professor.
So when he came in, he had a chance to do that. And we got to think back in the context of what Boeing labor relations are like. For more than a generation, Boeing's unions had been screaming that management was destroying the company. And at this point, basically everyone looks at Boeing and says, well, the unions were right. The critique, the central critique they made, that the management had focused on short-term profits and destroyed Boeing's engineering excellence, I don't know anyone who denies that anymore. That is just true. But over the span of a generation, whatever trust that might have existed between managers and the workforce of Boeing has just been devastated. I just want to sort of emphasize, right? Jim McNerney, the CEO of Boeing, a couple CEOs ago, actually said, right, when he was asked if he was going to retire at 65, said, "Why would I still do that? The heart is still beating and the employees are still cowering." That was the attitude that Boeing management had. When Kelly Ortberg came in from outside, a trained engineer, someone who had a history of working well with labor, he had a chance to reset that and say, look, I understand that my predecessors were doing these things and I'm not going to do it anymore. I'm a little surprised that he hasn't done more to seize it.
How do you see the negotiations playing out? And we are at an interesting point in terms of labor in the United States, given what we've seen and what we're seeing. In terms of it really is what do you call it? There's a buyer and seller's market, but it is a workers' market, I would think, right now. You can ask for things, and the company needs to listen. How does this play out?
Right, so it is a workers' market, and it's particularly a workers' market for Boeing workers because these sorts of skilled machinists who are the key to Boeing, they've already lost a lot of their most experienced and their best workers. That is one of the reasons for these pervasive quality problems. They really can't afford to lose too many more. And the other issue here is that touch labor, the people who actually have their hands on and are putting the plane together, only account for about 5% of the total cost of an aircraft. So there's a lot of room to play to increase that. But what I would suggest is this isn't just about money. Right, so Ortberg started in exactly the right way. He declared that he was going to work out of Seattle because Boeing's job was building airplanes and he needed to be there to do it right. But since then, you've seen things like Boeing going directly to the workers instead of working with union negotiators, them withdrawing their final offer, cutting off health care for workers. What I'd say is, if I were Boeing, what I would do is instead of trying to play hardball, the strategy they've done for a generation and that has nearly destroyed the company, I would sort of reach out to the union and say, we need a relationship of mutual respect, and maybe that's about more than money. Maybe that's about doing things like offering the workers some levels of a say in how the company is managed for the next few years. Because I mean, they couldn't possibly do worse than the last few CEOs of Boeing.
Where do you think the weaknesses were that led to some of the quality issues? And what would you do if you were Kelly Ortberg? What are the most important positions under him to get right?
So he needs to make sure, I mean, he is an engineer. He needs to make sure that his head of Boeing Commercial is an engineer, or at least someone who respects engineers, who understands them. He needs to get down on the needs to get down on the shop floor, walk around and talk with these people and say, why are you doing why are these mistakes happening in the most concrete way? And he needs to change the culture of Boeing. What we've seen over and over and over again is that the workers who are trying to do their job well, who blow the whistle, who say, look, we have a safety problem, get punished, get harassed, get fired, get moved out, get demoted, get sort of treated in every possible way badly. That is how you make sure that nothing of high quality is ever built. So changing that culture is going to require some pretty profound reforms, and it's not going to be a one-year process.
Yeah, Gautam, I hear what you're saying. Is it too late based on the early moves the company's made under the new CEO, or is there still the ability to turn that around, especially when we hear that the big sticking point is the return of a pension?
Yeah, I don't think it's too late, at least in part because officially or unofficially, Boeing has a backstop. It is just too important to American manufacturing for the U.S. government to allow it to fail. There will be interventions that make sure that this company keeps going forward because it is just inconceivable. If there's one thing that Republicans and Democrats agree on, is that the U.S. should be a leading manufacturing company, and the U.S. is not should be a leading manufacturing country, and the U.S. is not going to be a leading manufacturing country without Boeing. It is not going to happen. But what I would say is he needs to get involved with the labor negotiations because Boeing's current negotiators seem to be acting the way Boeing's negotiators have acted for the last few decades, and that's not working. He needs to say.
Anyway, when I'm gonna do open panels, like I've done it a couple times, but that's if I have more time after I'm done giving all
Hey,
the
we're going to do
reports,
this
all the
differently. This
lessons
is a
and stuff
CEO
like that.
level.
So yeah, it's gonna take a while. Yeah, what's up, Lolo? Yeah, thank you for the appreciation. So yeah, J Rilo, I mean, what's happening this month is I'm just slamming through everything I could possibly know, every topic I could possibly know, along with some updates. But then starting in November, it's just going to be more streamlined. Yeah. So where I'm just going to put up tickers and stuff and have model portfolios or something like that. And then we just start going like, yeah, full speed. And it'll be broken up probably into like some updates during the week, some updates during the month, and then some daily updates. And then we'll do more of a lessons maybe once or twice a week. So I'm going to go through all the past videos this month, see what I liked, I didn't like, what topics I want to focus more on, and then start building a lesson plan. And that's going to be more professional. That's what it is. And then you can have like question answer type stuff, things like that. But of course, I'm also learning things myself because I'm not an expert on these things. So I'm trying to be an expert on all the stuff I talk about. And yeah, you'll see. It'll take some time. But the first things first, yeah, just focus on the tickers, looking at the charts, studying them, going over all the stuff. And let's look at what earnings are for this week. Let's see here. Here we are. So hopefully you can zoom in, see that. So that's what's happening this week. So we already went through some today on Tuesday. The bank earnings, very important. Citibank, Bank of America, and Goldman Sachs all did quite well. So far it continues the trend of very good bank earnings. Now, if banks are doing very well, that's very good for the economy because they tend to lead. And JP Morgan CEO Jamie Dimon on Friday was very bullish on the economy. Very bullish. And that caused transportation and housing stocks to go up. Very good sign. Very good sign. Bad earnings this morning was United Health Group. So healthcare insurance did not do so well, at least for that big one. I'm not sure about what happened with United. I didn't check. Let me check what the aftermarket for United Airlines is. Usually I don't follow airline stocks. Very terrible as investments. Probably only good for trading, maybe. But there's better things to trade. Yeah, nothing much happened. They have a big $1.5 billion buyback. Yeah, nothing much after hours. So, so. They beat earnings, but so. Nothing, something to write home about. JB Hunt. Yes, that is transportation stock. Let's see how that's doing. Up 7%. Excellent. So transportation. So if you're a trucker, you should be rolling in dough because the companies at least are doing quite well. Yep. Okay. Now, I think the news today was about ASML. Let's talk about that. Apparently, ASML is supposed to report tomorrow, Wednesday. That's what I expected. But hey, they leaked. The earnings got leaked, and it sent the NASDAQ crashing. Great, excellent. And, I warned HB. I said, you bought that Sox L way too late, man. Like today, on one Monday, when we were talking, it's a bank holiday. There probably weren't many traders on the desk. Nobody was around. And then I said, you know what? I bet you they flip the script to you tomorrow. They'll say there's a bunch of bad news. And guess what? There was some bad news pre-market. Some rumors about increasing the tariffs or bans on exporting chips. And then, okay, well, that's kind of bad news, but people have heard it already. So market opens. I didn't see nothing wrong. And then all of a sudden, 1 hour in, I see this red candle, this big one. And it just started dropping like crazy. And I was like, oh, I bet somebody dropped a fat stinking news, didn't they? Oh, yes, they did. They did. They leaked the earnings. Someone fat fingered on the website and leaked the earnings. It's impossible. It's amazing. You can't make this shit up. So, I understand why people say like, oh, it's rigged, but, I could sniff it. You've been in this market long enough. You can sniff it. You can sniff all this stuff. And I'll tell you why. Because here, so SOXL is like the leverage version of the SOXX ETF. XOXX is semiconductors. Okay, one of the semiconductors ETFs. The other one, I'll use this chart. I'm looking at Hong Kong right now, see how it's doing. But anyway, so XOXX, this is what I'm following. Okay, this is not the leverage version. This is not what HB bought. But this day right here on Monday, you had this pump up on nothing, just NVIDIA. Because NVIDIA over the weekend, or the media would say, there's some rumor that they're going to cut prices on some GPUs. And it was like, oh, all right. Cut some prices. That means good. All right. So it pumps up on this, but there's no other news. It's a Monday, no earnings on Columbus Day, Indigenous whatever day, Italian American something day. Yeah. And then on Tuesday, he gets a little bad news. You get a little bad news, right? But it's nothing major. So it just drops a little bit for the first hour or so, half hour. And then this candle appears. It's like, what's that? Someone say something? It doesn't look that bad. And all of a sudden you get this one. Uh-oh. Well, you erased all of Monday's gains. And then the big thing hits. Boom. All right, everybody starts panicking and selling because it drops through a certain level. And it's just like the rest of the day is just like blah, 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 blah. So I'm following this. And, I'm thinking like, how interesting. Because if I zoom out, that whole red candle for today's trade, open to close, pretty much consumed this purple square or rectangle, purple zone that I drew way back when, starting from March. So I drew it based off of the close of this last major green candle and the top, about approximately the top of this red candle here. And so this huge volume red candle, this was basically a major top for the NASDAQ. So I would say anything from here would influence anything in the future. And that's it. When you do charting, you just look all the way back. Look at the lines all the way back. Look at everything from the past. See what's important. And you'll realize there are a lot of levels. Like here in 2021, that's an important level, which we revisited in 2022 because we crashed down here. 2022, we came back up to 2023, and we would revisit it. 2022, we revisited this one, this last high from September 2020, just before the elections. So this area you could see is very significant because we didn't break out fully until you got to election day. So this was election week right here. And after that was the vaccine news just after that. And then that's a major area. So any area you make, and you see here, we've revisited in 2022 right here. See, we hit that bottom and we went back up. So anything you see, you must look to your left. Look to your left, look to the past, see if there's anything. Now, right now, we don't have much past because we're at new highs. We're making new highs here. So that's why every time you start making new highs, you just got to be a little careful. You got to make sure the momentum isn't weakening. That's when you have to use it that way. Otherwise, you can use the price action from the past to predict something that might happen in the future, Of course, it's not going to be accurate all the time. It's not crystal ball. It's not. I'm not going to say like, oh, it hits that line, it has to do something. But most likely, it will do something. It has to struggle a bit at least if it wants to break out above it, and then when it lands towards it, it would try to support. At least people would hold it and not get freaked out, right? So that's the goal. But anyway, let's go back to here. So we see this rectangle I drew because March was the last time we had a major interaction before we had to drop, because after that it weakened, it couldn't get back in the box, and then it just rolled over. And now we're just going back up, right? And this was around May, and you see here it had trouble. It got to the top of that box, struggled, made this minor new high, and then it rolled back, but it held because this candle here stayed above this line, so it at least was within the box. It didn't drop significantly below it, and struggled, and finally broke out. So after that, we see, okay, what's the next box here? This box is a minor box because this is based off of the high of this last move, and you see a lot of green candles here before it gapped. So that gap kind of shows you where it is. And then once it went up here in June, look, it fell back into that gap. It tried to fill it, try to make some decision and decide, okay, I'll make one last attempt before this big red candle. And this is where the real top was. So this is a daily candle, okay? So I think if you looked in here and you weren't like, okay, if I looked in the S&P 500, I didn't see none of this. You see this? It looks like completely different. You didn't see that kind of action. So when people were just looking at the S&P 500, they started seeing this drop. They probably got caught off guard. But if you were looking at the semiconductors, it was already weakening. You could see the weakness here, starting from this candle and then going on up. You see it couldn't even penetrate halfway through it. And then after that, it just went straight through. So the reason I'm looking at semiconductors is it's the leading sector. NVIDIA is the leading stock, and NVIDIA is the one leading. Therefore, its sector is leading SOXX, and then SOXX leads the NASDAQ, which then leads the S&P 500. So this is the driving force of the market right now. So that's why we're focused on it. If you look at how this one leads, you'll know where it's going. And you can see it never made a new high here. So yesterday, it barely got back up to where it was in July 24, 2024. And if we look here, S&P 500's already made a new high. If you look at the S&P 500, there's nothing wrong. But it's the one that's driving it up, So if the semiconductors don't push it higher, this is going to have a hard time breaking new highs. The only reason it's going up right now like this is that we have, look at transports. Ooh, transports. Very nice. Very nice. So you got that good, nice talk on Friday from JP Morgan's CEO, Jamie Dimon. And it's like, economy's doing great. Transport's doing great. Transports meaning all the trucking stocks should be doing well. And today we got a nice report from JB Hunt. So I think tomorrow will be very good. It'll continue. XLF also moving up. Nice. Bank. All the bank reports are moving nicely. So we are continuing on. This is good to see. And therefore, the next thing we want to see is the small caps. Our small caps right now still stuck all the way from this little high in July. So small cap ETF IWM. Okay, look at that. And this box here, this yellow cyan box I drew, is something that was made in January 2021, and it's had a hard time trying to overcome it. It tried to overcome it in November of 2021 before the big epic crash of the markets along with bonds when the Fed started raising rates. So this should have been a clue for anyone to say, wait a minute. something's up. Something stinks, because this was in November 1st, the last green candle. And then the week after, November 8th, okay, it's trying to make a top. And then just before Thanksgiving, it makes this red candle, almost eliminating most of the gains here. And then you get into that COVID Omicron news. And then you get Jerome Powell, blah, blah, blah. Yeah, at that point, you would have thought like the next year probably wasn't going to be good. Because if the small caps don't lead, it's going to be a problem. That is a problem. So this is what you want to see. If you think the economy is doing really, really well, and you want Jerome Powell not to be cutting rates because the economy's weak, you want to see bonds stay subdued. So right now, bonds are subdued. So here are the bonds right now. It went to this resistance at 99. This TLT is the ETF for 20 to 30-year bonds. It's come back to this blue area. I'm expecting it to go back up again. But what you want to do is you want to keep this within a range from now on. Like, don't crash, but don't rally too hard. You don't want to compete with stocks. So I want it to be here. So if you think the stock market is going to do into next year, you don't want this thing to really break out in strength, and you don't want it to break down. So keep it nice and steady. That's your Goldilocks level. Same thing with dollar. So DXY is the US dollar index. So yeah, you don't want it to be too strong or too weak compared to other currencies. You want to be staying around here. Keep it staying. That's what you want to see, because if those cases are true, then we can have a good time. And gold can go up. It doesn't matter. Gold can keep going up. It doesn't mean shit. Okay? It doesn't mean like, oh crap, stocks have to go down. There's a lot of times when gold will go up along with stocks. And at some point, that relationship will break. We'll get to that some other time, probably next year. That's when we know things will happen. But for now, no, don't worry about it. So remember, IWM, you want the small caps to break out of this square, rectangle, I mean, okay? Then you want bank stocks to continue its strength like we're seeing now. Very good. And then now we see transportation's about to break out. We haven't seen this breakout since here, April 2021, May 2021. Yeah, April, May, that area, that time period. Once you see that, that means economy's fine. Stock market thinks economy's fine. The only reason it's not is when the stock market says it doesn't. And stock market leads everything else. So this ratio here, I talked about secondary indicators some time back. So this is the transports over industrials. So it's kind of like Dow Jones transports over Dow Jones industrials. Same thing, same similar idea. So this is IYT over XLI ETF. So similar concept. You want transports to be leading industrials. When you see this, that means economy is not doing good. But how come the stock market doesn't care? Because USA is not the same as it was back in the youth of my time. We are now a service economy. So we can tolerate weak goods type manufacturing economy. Not too long though. Can't be too weak now. But I like that it's turning around. It's trying to. If it turns around, then yeah, you can't be bearish anymore. Anybody that thinks like something really catastrophic is going to happen probably isn't going to happen. But you never know. There can always be a financial boogeyman coming around the corner somewhere. But at this point, from what I see, I do not see anything from these secondary indicators. But you know, we always should be inspecting them, seeing any clues if there's a hint that something's up. But this is very encouraging for next year. We could be having a very strong year next year, especially when all the people give up on staying in treasury bills, which give about 5% at least a couple months ago, and now it's dropping to 4.5%, and then it's going to continue dropping to 4% when the Fed keeps cutting rates, and they're not going to look so attractive. People are greedy. They rather put their cash into something that gives them fat returns, and that's what's going to happen, I think. Okay, let's go back to articles, and I'll show you the articles where everything was all messed up today. Very, very messed up. Very messed up. Actually, I'll give you a bearish news about oil here. So this is what two organizations have said about oil over the weekend. This one is today, though. This one was today. Let me do the one over the weekend. So this is OPEC. OPEC cuts 2024 to 2025 global oil demand growth view again. So this makes a third cut in 2024 for oil demand growth forecast. Cuts view on Chinese demand growth to 580,000 barrels per day. IEA to publish updated forecast Tuesday, which I will go over to next. So on Monday, cut its forecast for global oil demand growth in 2024, reflecting data received so far this year, and also lowered its projection for next year, marking the producer group's third consecutive downward revision. The weaker outlook highlights the dilemma faced by OPEC Plus, which comprises the organization of the petroleum exporting countries and allies such as Russia, which is planning to start raising output in December after earlier delaying the hike against a backdrop of falling prices. On Monday, OPEC in a monthly report said world oil demand will rise by 1.93 million barrels per day in 2024, down from growth of 2.03 million barrels per day it expected last month. Until August, OPEC had kept the forecast unchanged since it first was made in July 2023. China accounted for the bulk of the 2024 downgrade. OPEC trimmed its Chinese growth forecast to 580,000 barrels per day from 650,000 barrels per day. Okay, while government stimulus measures will support fourth quarter demand, oil use is facing headwinds from economic challenges and moves towards cleaner fuels, OPEC said. So, a lot of this stuff is driven by China. So that's a big problem. Big problem. But you know what? That helps with the inflationary issues from energy, at least. You don't want that oil to be creeping back up too much. But also, yeah, you don't want demand to be crashing either. Oil companies not making good money means that they'll start reducing production. Yeah, that's no good. It's really hard to get them to increase production later on. That's usually the problem, man. All right. Blah, blah, blah. Yeah, yeah. Mm-hmm. Let's see. OPEC report projects demand for OPEC plus crude or crude from OPEC plus the allied countries working with it at 43.7 million barrels per day in the fourth quarter, in theory allowing it room for higher production. All right. Yeah, there's not I mean, there was something about Libya having issues. Because it's still two countries, I think. Libya is still divided as two countries. Shit. Oh, what a mess. Anyway, IEA trims oil demand forecast for third consecutive month. So this is today. The Paris-based organization forecasts global demand to grow by 862,000 barrels per day this year from 903,000 barrels per day previously. So we're shrinking here, huh? The International Energy Agency trimmed its forecast for this year's oil demand growth for the third month in a row as rapid slowdown in Chinese consumption weighs on the global outlook. Always China. China. Okay, this marks a sharp slowdown from the roughly 2 million barrels a day growth seen over the 2022 to 2023 post-pandemic period, with total demand now expected at an average of 102.8 million and 103.8 million barrels per day in 2024 to 2025, respectively. Okay. So let's see. Chinese oil demand continues to undershoot expectation and is the principal drag on overall growth. All right. So China accounts for about 20% of the global gains, both this year and next, compared to almost 70% in 2023. Ouch, 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 ouch. The IEA's projection remains substantially lower than those of the OPEC plus countries, which we saw previously. The group of oil-producing countries trimmed its forecast earlier this week. Yeah, we know that. Okay. Global demand rose by 680,000 barrels per day in the third quarter at slowest pace since the fourth quarter of 2022 when China was in full lockdown. Meanwhile, Chinese demand contracted by 500... oh, man. I hope that comma's right. 500 barrels a day? Or is it 500,000 barrels a day on year in August, after having declined by an average of 190, I guess, thousand. They forgot zeros here. Barrels a day since April. Still, the agency said it expects the country to return to modest growth in the fourth quarter of this year and in 2025, when annual demand is projected to increase by 220,000 barrels a day. Recently announced government stimulus package, yes, we know this, are expected to support the resumption of an upward trajectory. But the overall impact is likely to be limited, and we anticipate any increase in oil demand will be overwhelmingly dependent on growth in petrochemical feedstock products. Oh, that means pig feed, right? Tuesday's report came as crude prices plunged 4%. Yes, on easing concerns over Iranian supply disruptions and a weaker demand outlook for China failed to provide details on the scope of its stimulus plan. Oh, yeah, we'll talk about that right after this one. Brent crude currently trades around $74 a barrel, while U.S. Oil gauge, the West Texas Intermediate, is around $71 a barrel. The price slide was also driven by a Washington Post report saying Israel told the U.S. that it's willing to strike military rather than oil or nuclear facilities in Iran, suggesting a more limited counterstrike and easing fears of a wider war. Okay, there you go. Okay, that's enough there. I'll put the links for people in chat if they want them, so you can read that yourself. Read these two things. But overall, oil ain't going nowhere anytime soon. That's about it. Let me pull up the oil chart. See what we got here. See how China's doing tonight. Still struggling, but it's trying to recover. Let's see. Yeah, it's trying to recover. Yeah, so I shorted up here. Like on that Monday, I shorted it. I shorted China. Then I added to it on Monday. So I got some more gains, but it looks like I'm going to lose some of those gains right here. It's trying to recover. It's trying to recover this area. So this is a pink line here at 20,367 in the Hang Seng 33 index. Okay, well, let's see what happens in the coming days after this. I don't know. U.S. oil. West Texas Intermediate, about 70 bucks right now. So it's lost most of its little gains up here. It tried to get back to 80, fell back. The lowest so far is 66, made in September. 65 to 66, yeah, made in September 10th. So I look at some ETFs for oil. Yeah, it's stuck. It's stuck. XLE. Yep. Chevron. Let's look at Chevron. Earnings will be reported Friday, November 1st. So we got some time. Yeah, not looking too good. I think HB bought it down here. Bought some again. Maybe 140 to 135 area. He's probably all right. He can hold that. But yeah, it's not going to be an easy ride up, I think. It's going to take some time. All righty. Anything else? Oh, another transportation stock I want to mention is Zim. Still looking at that. I kind of bought too early. I bought it around here, 24, added at 22, then I added at 19. I should have just waited. But, you never know if that strike was going to last a little longer. Might have juiced this thing further up. But once they resolved the strike issues at the ports, yeah, that thing was just news driven. It's just going to drive it down temporarily. So it's recovered a bit in the past 2 days. As I said, with IYT, the transportation. So anything transport related, we got tankers and ships. This is the way to be, I think. Yeah, we're gonna keep holding on this range. Hopefully, it'll get back up to about 24 again shortly. If we get more good earnings, give me good earnings in a transportation index, and we should be doing fine. Oh, the other thing too is home builders. So anything with home building should be very good with the economy and interest rates retreating. So, yeah, I recommended home builders around here in July. It's a very nice outperformer. It's kind of volatile. You can see here. Yeah, not a nice thing to hold. But this is the ETF ITB. You can use that. But there are also individual stocks too. Here, let me find them. Toll Brothers is one of them. Yeah, you have Toll Brothers. You got M1 Homes, MHO. Toll Brothers is TOL. You got KB Home, KBH. Lennar, right? LEN. Pulte Group, PHM. DR Horton, DHI. And NVR Incorporated, NVR, which is a very nice chart. Very nice looking chart here. Okay. All right. Let's see. Let's go back to the news articles. Remind me what else I need to talk about after I read some of those. So we talked about oil. We're done with that. Now let's go on to China. Did I have some China stuff set up for you guys? Yes, I did. I had a couple. This is from Bloomberg, October 14th, yesterday. China's credit expansion tops forecasts, but loans disappoint. China's credit expansion exceeded expectations on September, helped by a surge in government bond sales, while new loans disappointed in a sign of still weak domestic demand. Aggregate financing, a broad measure of credit, increased 3.8 trillion yuan, or about $537 billion, according to Bloomberg Circulations, based on data released by the People's Bank of China on Monday. That compares with a median forecast of 3.6 trillion yuan by economists in a Bloomberg survey and an increase of 4.1 trillion yuan in the same month a year ago. Okay, so not really big compared to those 2 months, I guess. Financial institutions offered 1.6 trillion yuan of new loans in the month. Bloomberg calculations showed the median forecast was 1.9 trillion yuan. The PBOC introduced a barrage of stimulus policies in late September, including outside cuts to interest rates and the reserve requirement ratio, which freed up cash for banks to lend. The impact of such steps will probably take time to materialize, meaning it likely had yet to be reflected in the latest data. September is typically a busy month for borrowing activity because banks are in a rush to meet their quarterly loan targets. The headline credit figure also benefited from a jump in government bond sales, which had been slow earlier in the year. Over 1 trillion yuan worth of local government special bonds, a key funding source for infrastructure investment, were issued in September, and most since June 2022, according to data compiled by Bloomberg. Credit demand has been stuck in low gear in the past 2 years as households and businesses turn cautious. It's also been cooling because of a housing downturn and authorities' efforts to rein in debt that piled up among local governments. All right. The risk is that the country's entering a prolonged period of low demand and deflation, which could threaten its growth prospects for years to come. Yeah, we all hear about inflation. You definitely don't want the reverse deflation. Yeah, prices go down, but yeah, so will everything else with it. So, let's talk about Chinese cars. This is a good indicator of how they're doing. If the Chinese middle class isn't buying up cars, yeah, that's probably not a good sign for anything else. So we gotta look at the cars, man. China's car sales snapped 5-month decline on subsidy boost. Oh, okay. China's passenger vehicle sales rose in September from a year earlier, snapping 5 months of decline with a boost from a government subsidy. All the gains came from battery powered vehicles. Sales of electric vehicles and plug in hybrids jumped 50.9%, accounting for 52.8% of overall sales. It was the third month in a row that battery powered vehicles, including plug ins, outnumbered sales of gasoline engine cars in China. Yes, this is big deal for Tesla. Let's jump to this article for a while we're talking about this. Tesla China produces 3 millionth vehicle. You know, look at all these people here, all working in that factory. 50% of Model 3 plus Y total. Tesla has shared on social media that Tesla China has produced its 3 millionth car. That's quite an accomplishment for Tesla's second car factory. It also reveals just how much of Tesla's business is reliant on Chinese production. It's a useful time to receive this update, as I also just recently reported that Tesla passed 6 million cumulative Model 3 and Model Y sales in the third quarter. More specifically, cumulative sales of the Tesla Model 3 and Model Y reached 6,021,007 units at the end of September, with the 3 million unit milestone in China passed just a short time later. We can see that China has produced nearly 50% of the Model 3 and Model Y electric cars ever produced. The rate of production growth in China might be faster than in the United States and Europe combined. We'll have to see if the Chinese factory reaches 4 million vehicles produced before cumulative sales of the Model 3 and Model Y reach 8 million. When Tesla Vice President Grace Tao shared the news on Weibo a few days ago, she also noted that the company had gone from 2 million to 3 million vehicles produced in China much faster than it had gone from 0 to 1 million. Today, we released the Robotaxi driverless taxi. And here is another good news to share with you. Today, the Shanghai Super Factory ushered in a new milestone. Yes, the 3 millionth vehicle rolled off the production line, she noted. It took Tesla Shanghai Super Factory 32 months to go from 0 to 1 million vehicles. It only took 13 months to go from 2 million to 3 million vehicles. Each car is a small step, and 3 million is a big leap, the Tesla executive wrote in her post on Weibo. The company doesn't produce cars just for China in China. It is also Tesla's primary vehicle export hub, having exported 1 million vehicles as of late September 2024 to Europe, Asia, and in countries such as Australia and New Zealand. It's all great, amazing progress, and some people claim that the site of the Shanghai Tesla factory would never be more than a mud field. How times have changed. All right, so there you go. There's your propaganda for today. But yes, I think we definitely have to keep an eye on this, because a lot of Tesla stock value is going to be riding on how this is going to work here in China. So you have to remember, not a lot of that stuff has to have domestic demand in China. So back to the original article, China's passenger vehicle sales rose 4.3% in September from a year earlier, snapping 5 months of decline with a boost from a government subsidy to encourage trade-ins as part of a broader stimulus package. All the gains came from battery-powered vehicles whose buyers and manufacturers have benefited since July from a doubling of subsidies to consumers, while sales of gasoline cars in China, a market foreign brands once dominated, continue to shrink. So, I guess BMWs and other things. Yes, yes, yes. Sales in the world's biggest auto market hit 2.13 million vehicles in September, up from 2.04 million a year earlier. For the first 9 months, sales were up 1.9% from 2023 levels, according to data from the China Passenger Car Association. Sales of electric vehicles and plug-in hybrids jumped 50.9%, accounting for 52.8% of overall sales. Okay. It was the third month in a row that battery-powered vehicles, including plug-ins, outnumbered sales of gasoline engine cars in China. All right. Sales of EVs and plug-in hybrids, a category the Chinese industry group classifies as new energy vehicles, hit 1.12 million in September and 7.13 million for the first 9 months. Global EV sales have slowed this year, with automakers outside China scaling back production. Sales in China, however, have risen, driven by expanded subsidies for consumers trading in older vehicles for EVs and more fuel-efficient cars, a program likened to the U.S. Cash for Clunkers stimulus in 2009. Tesla sold over 72,000 vehicles in China, up 66% year on year, its best month this year. The U.S. headquartered company exported 16,121 China-made vehicles in September, down from over 23,000 the previous month. Tesla, which counts on China for about a third of its sales, has added its own incentives, including 0% financing. Chinese EV makers BYD and XPeng reported their best ever month in September. Okay. So China's best-selling new energy vehicle makers through the first 8 months were BYD, Geely, and Tesla. All right, I'm not going to go over the subsidy stuff. This is important for you to remember, BYD and Tesla. Okay, I've talked about it quite enough. So let's look at their charts. See what we have so far. Now, Tesla had its little event. Very funny, right? Because it was Thursday night, and the next day, it crashed. 8.78%. It still has not recovered since, right? We got to wait for earnings. Earnings is next week, Wednesday, 23rd, October 23rd. Okay, put that in your calendar. Now, let's look at our other two, actually 3. I'll look at 3 Chinese EV companies. All right, I'll look at this one. The Xiaomi does more than just EVs, but for now, it's one of the best performing Chinese stocks, like overall. So you might as well look at it. So yeah, it's pulling back with the rest of the Chinese market. Actually, let me double check how China's doing now. It's still trying to hold on. We're still trying to hold on here. Okay, we'll see how it goes for the rest of the week. So back to Xiaomi. Okay, let's go back to daily. Look at the daily chart. Yes, it's falling back. I'll definitely consider buying this one if we get around to 13. Maybe if I get lucky, I can get it at below 12. BYDD, yes, something that I keep following. And I said way back when Ryan asked me about this chart, it's like, how do I know it's going back up? Well, I see this volume here. You see that? Large volume here. You keep continually seeing volume. So it's kind of like a up and down motion here, where there's a lot of volume at that apex at the bottom. And, well, here we are several months later, and we hit the top of that box. And we bounce back down. How amazing. what I would suggest is that if I was still bullish, if I believed that this thing was not going to just collapse and go all the way back down and go through this box and fall, is that this thing will hold, at least try to hold halfway the midpoint of this box at around 60. So it should stay about above 60. Let's just put it roughly about there. So it's around, it should just bounce here, zigzag, zigzag before getting out of here. So if you're looking at a Wyckoff accumulation picture like this, see that? That's what I want to see. So I'm going to copy this. Let's go back. Okay, let's go back to here. Let's copy this. You see that? Okay, that's what I want to see. Basically, want to see this. Something that looks like this, okay? So I think we got this little spring area here. We got this first initial test here. A second test. Yeah, this basically is our spring, or final spring anyway. And we're going up here, and it better zigzag, stay above 60 before breaking out. I didn't do a price projection on this, but hey, I think with this range that lasted from October 2020 to now October 2024 for 4 years, it's been on this range. I think, yes, I would say this thing can go pretty high in theory. All right, depending if China can get its act together and stimulate and not go to war with Taiwan or some crazy shit. Now here, let's look at this one. This is terrible. This is a terrible looking stock here. So this is another Chinese EV maker. I'll show you another one. So that one was LI. This one's Neo. Oh, look at this. It just drops like crazy. Goes from $70, almost hitting $70. It goes all the way down to 3. It looks kind of like it's making a bottom. I'm not sure. I'm not sure at all. But if you're interested in Chinese EV makers, then just stick with this. BYD Corporation. So BYDDY. Look it up. This is not traded on NASDAQ or NYSE. It's an over-the-counter stock. So BYDDY. And the other one is Xiaomi. XIACY. They also make phones. So Xiaomi make phones and as well as cars. BYD also makes all your lithium batteries. Most likely all your lithium batteries are made by there. The ones in your pockets anyway. So BYD is a prolific battery maker, lithium ion battery maker. So yes. And we have to wait on how Tesla's doing because yes, you can see that it also in a range. It hasn't really gone anywhere, really. It's a quite large range though. I mean, don't get me wrong. It's going from 100 up to 290. Yeah, that's quite wide, right? So, hey, what does that tell you? This thing is building a lot of energy here, not only in time wise, but price action wise. So, yeah, we'll see. We'll see. It can be like a BYDD in extreme cases. So this thing is acting in extreme ways. So if it can make a lot of Chinese sales, that's good. Now the interesting thing is when it did its like little robo taxis service announcement, and the stock market didn't like it. Let's look at Lyft. Lyft popped. Lyft popped up. Look at DoorDash popped up around the same time. And Uber. Pretty bizarre, I thought. So if I guess some people were betting that Elon was going to kill all 3 of those companies with his announcement and people were shorting it, Uber, Lyft, and DoorDash, because that's a weird pair trade in any case. So yeah, look up pair trade. Look up what pair trading means. I think you guys should learn that. But that is bizarre. If somebody was shorting Uber and longing Tesla for that event, and then someone else was doing the opposite trade, that makes no sense to me. But yep, Uber popped on that news. And if I have time, I'll go over a video with the detailing how you should look at Uber's stock right now. So yep. Let me see. Let me do all the links for the articles I was reading about the cars and China. Like right there. You can get that. Right here. Another one for China. Right there. And finally, Tesla's China. Yes, there you guys go. Make sure I also put on the screen the other articles I read about oil. Right there. Make sure you got that. Okay, we're done with those. Okay, we're done with those. Clear them out now. So other videos I was putting in the beginning were AI videos. And now let's switch gears to AI and semiconductors. So let's talk about the semiconductors stuff here. So let's look at the good news. The good news that pumped the whole stock market reaction on Monday. Okay, so you look at that, you see it drop and whatever, but let's look at Nvidia, right? So that's just a refresher memories. Now you see this is it right here. This was the reason why it was pumping on Monday on Columbus Day. Yeah, you see that? So this whole area here, with this red candle to this red candle I did, look at that. So once it went back up there, went back up to this area, and if you look down here, back in August, late August, from August 20th to 27th, yeah, this was a distribution, basically of making a distribution before crashing back down. So it barely even went into that shaded area I put here. And now we're back into it. We're back into that area. And it pumped it right up to near the top, didn't it? What news would have made that happen? What dumb news would have made that happen? So let's look. That's why nothing should surprise you. You should kind of predict where the news is trying to take it. Once you look at the charts long enough, you'll see. You'll see. So, what dumb news did they have for us on Columbus Day? So, Nvidia shares rose 1% in pre-market trading on Monday as Wells Fargo called media reports that the semiconductor giant will price its DGX B200 systems at $500,000 or more as an incremental positive. While we think it is always important to consider that actual pricing can differ from list prices, and we continue to believe it is difficult to drive NVIDIA estimates solely on system price times quantity. Example, NVIDIA's expanding platform monetization a key unappreciated input. We do think the 40% plus higher pricing of the DGX B200 versus DGX H100 systems could be considered higher than expectations. Okay, analyst Aaron Rakers wrote in a note to clients, we think this level of pricing could also ease any concern over NVIDIA's gross margin percentage dynamics. And with NVIDIA delivering its first DGX GB200 systems to OpenAI and Microsoft, demand is likely to be paramount for investors, Rakers said. He has an overweight rating and $165 price target on NVIDIA. As we move into NVIDIA's Blackwell platform cycle, we expect investors to be particularly focused on NVIDIA's GB200 NVL72 rack scale demand, the analysts explained. We continue to think that data points, comments coming out of key partners such as Foxconn and Quanta as some of the early indicators. All right, so we got rumors of price increases. Yes, we see demand probably going up if they can command a higher price. So people are bullish. People are bullish. And then what happens the next day? We get this stuff. So this is today. NVIDIA falls. Okay, I'm zooming in. NVIDIA falls as export ban risk grows, reports say. Is NVIDIA buy now? Oh my God. Pullbacks can be normal, especially after a strong run, but it is still important to see what a stock does as it pulls back. Oh, God. Some AI wrote this crap. Anyway, after nearing in an all-time high Monday, NVIDIA was falling on Tuesday. I wonder why. Amid news that the company's advanced chip exports could be up against more restrictions. Sales restrictions on NVIDIA's AI chip exports to 40 countries are already in place and may now extend to the Persian Gulf. According to reports, discussions on new limits are in the early stages. Who's making this stuff? Who's making all these reports? One way of checking to see if the stock has a base. Oh my God, this is some ad crap on market condition. Here's a quick rundown on some metrics. Okay, this is all ad crap. Ad. I don't think there's anything useful here. All right, let me read this then. Foxconn plans server capacity boost. NVIDIA shares also rose amid reports that Apple iPhone maker Foxconn plans to increase server capacity to meet crazy demand for NVIDIA's Blackwell chips. Those Blackwell chips again. Foxconn chairman Young Liu added, the company plans a capacity of 20,000 of its GB200 NVL72 servers in 2025. GB200 NVL72 server is a liquid-cooled system. There's that water demand's going up. It connects 36 central processing units and 72 Blackwell graphics processing units to improve inference tasks. But Foxconn faces a hiccup, as NVIDIA is likely to ship its newest artificial intelligence chip later in the fourth quarter rather than earlier. Earlier, the stock fell amid reports from Barron that China was trying to boost local AI chip makers and urging local companies to avoid NVIDIA chips. China accounted for 11% of NVIDIA sales in the first half of fiscal year ending in January. All right, let's do this. NVIDIA stock, AI's total addressable market. So total addressable market is TAM. That's business jargon. You'll hear that a lot when they say TAM. That's what it means, total addressable market. In September, consulting firm Bain said the total addressable market for AI hardware and software will grow 40% to 55%. Consulting firms. For at least the next 3 years, demand for NVIDIA's next generation graphics processing units, GB200, expected to reach 3 million in 2026 versus 1.5 million for its H100 units in 2023. All right. Another dude says it's a $165 price target. All right. So nothing else there. Let's see. Let's look at another reason why the stocks crashed today. So that didn't really scare the market too much with the whole thing about added restrictions in NVIDIA, right? And that really didn't scare it that much at the beginning for the first hour. This is what really crashed it. ASML stock falls after Q3 bookings missed earnings. It wasn't supposed to report earnings today, though. ASML stock tumbled 14% on Tuesday after Bloomberg News reported the company's third quarter bookings missed estimates. The Dutch company, which makes extreme ultralithography machines, okay, you guys should remember this company. This Dutch company makes EUV machines. Okay, that's what extreme ultraviolet is. It's banned from being exported to places like China. All right. It's slated to release its third quarter results on Wednesday. The results appear to have been mistakenly pre-published on the ASML's investor relations website. Oh, who did that? Who did that? ASML's third quarter bookings fell 53% quarter over quarter to 1.63 billion euros compared to Bloomberg consensus estimate of 5.39 billion euros. Ouch. The company's net sales grew 20% quarter over quarter to 7.47 billion euros, beating estimates of 7.17 billion euros. Meanwhile, net income jumped 32% quarter over quarter to 2.08 billion euros, surpassing estimates of 1.91 billion, according to the report. All right, let's look at the outlook. ASML expects fourth quarter net sales to be between 8.8 billion euros to 9.2 billion euros, with a midpoint of 9 billion euros, slightly above the 8.95 billion euro estimate. The company sees gross margin in the range of 49 to 50%, estimate as 50.5% for the full year. ASML expects net sales of 28 billion euros versus estimates of 27.71 billion euros. For the year of 2025, ASML lowered the net sales forecast of 30 billion euros to 35 billion euros. Okay, midpoint of 32.5 billion euros. Previously, the company expected about 30 billion to 40 billion. Estimate 35.94 billion euro midpoint. So, yeah, nothing too bad, I don't think. Lowered some guidance, did some that. I don't know if it, it just missed that 50% thing here. Yeah, its bookings fell. I guess that's a shocker, but it probably shouldn't have been. And yet it crashed about 16% today. And it took the whole dang semiconductor and NASDAQ with it. All right. So I'll put that in the link for you guys. You guys should read that if you want, or you want a record of it. Okay. And this one, that's it. I don't think there's too much else in the articles. Yeah, I'll put that on the screen. You can read that later. Let's see, anything else with the AI? Ah, yes, here's the last one. So this is what was in the early morning. So this will go in more detail of what they wanted to ban. U.S. weighs capping exports of AI chips from NVIDIA and AMD to some countries. Okay, we're reviewing AI chip policy for the Middle East now. It's unclear whether measures will be imposed in Biden's term. The approach would set a ceiling on export licenses for certain countries in the interest of national security, according to the people who describe the private discussions on condition of anonymity. Officials are focused on Persian Gulf countries that have a growing appetite for AI data centers and the deep pockets to fund them. Ooh. Deliberations are in early stages and remain fluid, the people said, noting that the idea has gained traction in recent weeks. The policy would build on a new framework to ease the licensing process for AI chips shipments to data centers in places like the United Arab Emirates and Saudi Arabia. Commerce Department officials unveiled those regulations last month and said there are more rules coming. The agency's Bureau of Industry and Security, which oversees exports controls, declined to comment. NVIDIA, the market leader for AI chips, also declined to comment. Yes, everyone declined to comment, but, damage is done. A spokesperson for the White House National Security Council declined to comment as well, but pointed to a recent joint statement by the U.S. and UAE on artificial intelligence. In it, the two countries acknowledged the tremendous potential of AI for good, as well as the challenges and risks of this emerging technology and the vital importance of safeguards. Oh, yes. Looks like we are getting worried to give it all around the world, aren't we? Some U.S. officials have come to view semiconductor export license, particularly for NVIDIA chips, as a point of leverage to achieve broader diplomatic goals. That could including asking key companies to reduce ties with China to gain access to U.S. technology, but the concerns extend beyond Beijing. We will also have a conversation with countries around the world about how they plan to use these capabilities. Tarun Chabra, Senior Director of Technology at the National Security Council, said at a forum in June without naming specific nations, if you're talking about countries that have a really robust internal surveillance apparatus, then we have to think about it. How exactly will they use these capabilities to supercharge that kind of surveillance, and what will that look like? Sounds like Palantir, huh? There's also the question of how global AI development could affect American intelligence operations, said Maher Bitar, another NSC official. What are the risks not just on the human rights ground, but also in terms of the security and counterintelligence risks in our personnel around the world? Bitar said at the same event. It's unclear how leading AI chip makers would react to additional U.S. restrictions. When the Biden administration first issued sweeping chip regulations for China, NVIDIA redesigned its AI offerings to ensure it can keep selling into that market. If the administration moves forward with country based caps, it may prove difficult to deliver comprehensive new policy in the final months of President Joe Biden's term. Such rules could be challenging to enforce and would be a major test of U.S. diplomatic relationships. Governments around the world are in the quest for so-called sovereign AI, the ability to build and run their own AI systems. And that pursuit has become a key driver of demand for advanced processors, according to NVIDIA Chief Executive Officer Jensen Huang. NVIDIA's chips are the gold standard for data center operators, making the companies the world's most valuable chip maker and the top beneficiary of the AI boom. China, meanwhile, is working to develop its own advanced semiconductors, though they still trail the best American chips. Still, there's concerns among U.S. officials that if Huawei Technologies Company or another foreign maker one day offers a viable alternative to the NVIDIA chips, presumably with fewer strings attached, that could weaken the U.S. ability to shape the global AI landscape. Some of U.S. officials argue that's only a distant possibility, and that Washington, there's no the Washington, should adopt a more restrictive approach to global AI chip exports, given its current negotiating position. Others warn against making it too difficult for other countries to buy American technology in the event China gains ground and captures those customers. While officials have debated the best approach, they've slowed high volume AI chip license approvals to the Middle East and elsewhere, but there are signs things could get moving soon. Under the new rules for shipments to data centers, U.S. officials will vet and pre approve specific customers based on security commitments from both the companies and their national governments, paving the way for easier licensing down the road. All right. So we got a lot to think about. Guys. Yo, what's up, San Jose? What's up? The AI wars have only begun. Now, let's switch gears. I'm not going to do any more tech stuff. Let's just switch gears right now. I can save the rest for later. Hims and Hers stock. So, you guys like Ozempic? You guys like diet pills? This is the stock for you. I've mentioned this last week, and for the past couple days, it's been zooming on this news. And we'll go over the chart after I go over this article. So, Hims and Hers stock jumps as FDA reconsiders restrictions on copycat weight loss drugs. Hims and Hers shares gained Monday after the FDA said compounding pharmacies. So we talked about compounding pharmaceuticals, okay, last week. So you can go back and review that. could continue to produce copycat weight loss drugs while it reconsiders whether there is a shortage. The change would be a boon for Hims and Hers, which makes copycat weight loss drugs and has benefited from the limited availability of some obesity medicines. With Monday's gains, Hims and Hers shares have more than doubled in value since the start of the year. Okay. So, yes, FDA said compounding pharmacies could continue to produce copycat weight loss drugs while it reconsiders whether there is a shortage of their active ingredient. The FDA is facing a lawsuit after it ruled earlier this month that Eli Lilly's LLY, another favorite stock of mine, popular weight loss drug Mounjaro and Zepbound were no longer on its shortage list. The agency allows companies like Hims and Hers to produce compounded copycat drugs when the originals are hard to obtain, allowing them to benefit from the demand for obesity treatments. In a court filing Friday, the FDA said it would not take action against companies that are in violation of its decision last week while it reconsiders the matter. The suit was filed by the Outsourcing Facilities Association, a trade association representing compounding pharmacies. Yes, all right. Let's look at the chart. And I'll put the link up for you guys here. There you guys go. And we can look at the chart now. We are done with that. This is quite an interesting chart, I gotta say. Quite an interesting one, you know. If I zoom out all the way back here in 2021, this was during the time when everybody had a SPAC and IPO and all this shit. If you remember those days, like just after COVID and everybody was releasing everything they could. Oh man, what a terrible time to buy. And I showed you last week. Let's compare it to the XBI ETF. The XBI is the ETF that has all the crappy little biotechs, all the risky ones. You can see it follows exactly like it, right up into the peak. 2021 is following, it goes all the way down because interest rates were rising back into 2022. Then it starts trying to get out. And guess what? It started to do better. It had one last drop right here into October 2023 before it started rising. And guess this, look at this. So this area here, this is what we got to look at. This part here, we're on this upward trajectory. Okay. Now this is from around $6. Yeah, $6 to 24 right now. And we're trying to retest that 24 top, that was made way back when here. So I'm eyeing this. I am eyeing this. This looks like it wants to break out. So if we consider this whole thing, this whole area, some kind of big base, and that's why I mentioned right at the beginning of this stream, look at small caps. Look at the small caps. You got to see this start leading. We can't just rely on NVIDIA and the QQQ to be leading, okay? That's not enough. So if you want to see some extreme action, this sector has to go up. And not only this sector, you're going to see like the XBI, okay? So biotechs has got to break out of this rectangle here and start moving back up to where it was in February 2021. We're far away from this. We're real far. So here, let me hide this thing. Yeah, we're really far from it. Okay. We got a long way to go. This is about yeah, we got 80% more to go on this ETF. And guess what? Once that breaks out and you look at something like Hims, So I'll have to do a price projection for this stock. I have to see what price I think it could theoretically hit. It already hit a nice low here at $2, you know, at the bottom. So this is quite a wide range. So we can conservatively talk about this area as being the first accumulation area, and then later on we could say like, okay, once it breaks out, let's see what this big cup here would give us later on, because this is quite a stock to pick. And you know, I might start talking about another stock while I'm here, talking about like crap stocks that are risky. Rocket Lab, another one of these SPAC stocks. You know, see, 2021 does a little pump, it crashes, it does this little going nowhere sideways kind of move for about from May 2022 till now. So we got about 2 something odd years, and now it's coming back. It's coming back here, right here. Isn't that interesting? We're right here now. So Rocket Lab, RKLB, is actually kind of like a light discount version, a scuffed version of SpaceX. So for people that can't afford to get their satellites launched on SpaceX, this is like a budget Dollar Tree version. Here, I'll show you a video.
For the audience that might just be tuning in for the first time, wondering where we are, Rocket Lab is an end-to-end space provider, space launch services systems provider. Bring us up to speed on what that means.
Yeah, we think that the space companies of the future are ones that aren't just a launch company or just a satellite company or just an operator of satellites. It's really all about providing an end-to-end service. So what you're seeing here in Long Beach is really our headquarters. We make a lot of the rocket components here, rocket engines, the avionics and so forth. So we have a pretty big footprint here in Southern California, but we've since expanded that. And of course, the company got started in New Zealand, but then expanded to the U.S. and starting to expand further throughout the United States, including locations in places like Denver and Albuquerque and Stennis, Mississippi and Silver Springs, Maryland, and of course a launch site in Wallops Island, Virginia, and a facility in Toronto, Canada as well. So we've established ourselves a very broad footprint, doing much more than just launch.
An HQ here in SoCal, which fits exactly what we're talking about. 2 launch systems, what are they and what are the differences?
Right. So the vehicle you see behind you is Electron, and Electron is the second most frequently launched vehicle in the United States. It's launched 53 times, so we've got a very, I'd say, significant lead in the small dedicated launch market.
Okay.
And we're developing a second vehicle, which is called Neutron, which will address the larger medium-class launch market.
Can we dig into the practicalities and how difficult space engineering is? Where are we with Neutron, and what are some of the issues and the steps of getting it up and running?
Yeah, well, we're quite a ways along the path of Neutron. So we've been at it now for a little over 3 years. We announced the program when we came public in August of 2021. It's amazing to see a rocket program come together. I hadn't come from a space background before joining the company about 6.5 years ago. And just to see what it takes to pull together and pull off a rocket development program is absolutely staggering. The complexity, not just from just
It's literally rocket science, Adam. You can say it.
It is literally rocket science. I'm grateful every day that there's people who have dedicated their lives to developing these complex systems that are absolutely amazing. So it's a very it's a very detailed, very arduous task to get there. And I think that's what's so exciting from a business perspective, is the fact that if you can do it, you're one of a few numbers of organizations in the history that have actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard. And we have I would say the challenge of waking up every morning and doing battle with physics, but also doing battle with some of the most fierce competitors on the planet, including SpaceX. And so we look around our industry and we see bodies everywhere that we have to step over.
Wow.
And it kind of makes you wake up every morning and kind of like, okay, this is a serious business. We got to make sure that we make all the right decisions, be very efficient with our capital, and very, very focused on execution.
I mean, you are the numbers guy. Let's just talk about capital efficiency.
Sure.
You have to spend an extraordinary amount of money. You took this company public. You're having to answer to a whole host of retail investors and more increasingly institutional investors. Mm-hmm. What's the revenue run rate, and where is the money coming from?
Yeah, we're very fortunate that we've been able to get now to a scale. So Q2, we generated over $100 million in revenue. So we really kind of now crossed that threshold of scalability. We've shown that a model can scale. I think it's very important that we've done it not just on launch, because launch represents about 30% of our revenues. Space systems actually represent 70%.
And just on that, when you say space systems is 70% of revenue, just in layman's terms, what are you talking about?
So we sell a variety of solutions. So we sell subsystems into the merchant market. So we sell things like solar solutions for spacecraft. We sell radios and battery systems and composites and so forth. So we really are very serious in materials to the merchant subsystem market, but then we also build full spacecraft solutions. So for example, we built full spacecraft for NASA. In fact, we built a couple spacecraft that are going to be orbiting Mars in the not too distant future.
Yes, this is big news for you recently.
Very big.
Because originally you weren't on that list, and now you are.
Well, that's actually for the Mars sample return.
Okay, sample return.
Sample return, yeah. And you're right, we were not included in the first, but we were ultimately added to that program, so that's very exciting. But when you look at all the different programs that we're across, again, not just subsystems, but we're actually making full satellites for, including the Defense Department and their Space Development Agency. We won a contract to be the prime contractor for over $500 million contract. So it's actually, the one thing that's most exciting for me is how quickly we've come from a very organic base to now building a very significant size revenue and getting, again, past that $100 million threshold per quarter.
And you talk about the Electron behind us, 53 already put into space. How many launches are we looking at in terms of the next year? What sort of cadence are you trying to live up to?
Well, we've indicated 15 to 18 launches this year. We've launched 11 times so far, so we've got a big Q4 coming up. And then when you look at the kind of rate going to next year, we see growth off of that. And a lot of it's really not dependent on how many rockets we can build. We can build a lot of rockets. We could build almost, we've kind of sized ourselves.
You're
to build.
3D printing a whole load of it.
We're 3D printing a lot of stuff here. We could build.
So what is the limiting factor?
It's really the market at this point. It's really the market. We can build as many rockets as the market demands, but it's a new market. It's a nascent market, and I think it just takes time for these markets to develop.
I want to get into this, the business of space, and just bear with me, Caro. Elon Musk.
I bear with you a lot.
Has a big gap right over you, a big sort of lead with SpaceX, and he talks about this idea that the business of sending payload to orbit tops out for them at $3 billion. Now that's a scale that you're not near yet, but it makes it seem like there's a cap, there's a ceiling on how much money you can ever make in this business. What do you make of that?
I think it depends on how you define this business, right? I think, even as we've seen with SpaceX, I don't think they stopped at just launch. So launch is a very critical part of the ecosystem, but it's not the biggest piece of the ecosystem. So the applications and creating that ongoing revenue stream from applications and having a constellation on orbit, that is really what people are shooting for as far as where the real scale for this industry comes from. And that's exactly what we're oriented around. We're all about being an end-to-end space company where we can design the spacecraft, we can build the spacecraft in a very vertically integrated way with our own subsystems. We can launch them on a variety of rockets, and we can operate those on orbit. So it's a very, very important thing to think about yourself as an end-to-end player, because again, if you're a bespoke kind of one solution provider, it's probably not the path to survivability.
For those institutional investors sat watching, and indeed retail investors who are excited about putting money into rockets.
Very excited.
Tell us about how the market scales up. What is needed? You're saying you can get these, you can build these as quickly as the market wants. Well, what gets the market to the next iteration, to the size that you want to be able to serve it at?
I think the most exciting thing about what's going on in this market right now is that you think about what typically drives the hockey stick growth kind of characteristic of an industry, and it's usually commercial. But I think we're in a really interesting period where we're actually seeing the hockey stick being derived not only from commercial opportunities. So everyone's seen what SpaceX is doing with Starlink. So that's kind of old news to a certain extent. But then you see Amazon Kuiper, you see Telesat Lightspeed, you see the SDA constellation. So you're actually seeing a combination of government and commercial all presenting hockey stick opportunities, and that's really it's not bet kind of situation right now. There's lots of different irons you can put your fire into.
Adam, there's so much more to come, as you know, in this hour. But before we let you go, a word for SpaceX, what they enabled your company to do, particularly here in California.
Well, I think you have to give them amazing credit for what they've accomplished. They really kind of are, I would say, kind of an inspiration and aspirational target as well. Like we've seen what can be done, right? And I think that's the one thing is we wake up every morning understanding the challenge that faces us, but we're not intimidated by it. That's one thing that this company does not ever get, is intimidated by competition, whether it's SpaceX or anybody else.
All right, so that's that's one of the stocks I've been following. Rocket Labs, very good potential there. I'm not saying it's riskless though. It's definitely not riskless. Not riskless at all, and it's about to complete its base. So you know what? When you look at this chart, you got to understand that whole Wyckoff premise that I keep talking about. Like, you could just tell right away. You got this nice accumulation. Now you're about to break out again. And I told you guys to do your homework, right? Do your homework. I'm going to keep reminding you. So here's the PDF. Do your dang homework. Put the link back up on the chat. You guys should do it, because this is exactly what it is. If you look at that PDF, you'll see exactly what this is. And today, for today's lesson, I'll give you an alternative. I'll give you an alternative way of looking at things. So I don't know what you talk about, Momo. Oh, scrubbing internet history. Is it? Has it gotten to that point? It probably will. We'll probably scrub a lot of history. I mean, the Internet Archive website's still down, right? So I'm pretty sure all the stuff will get wiped away. So yes, let's look at this. Actually, before I do, let me check how yeah, we're still around the same area here. We're still goofing around here, so we'll see. Right now, China is in this lunch. They actually do have lunch breaks in the Asian stock markets, so they're eating their little ramen noodles for next hour, right? So we got about 10 minutes. Yeah, so the same homework. Yes, that's right. Everyone should just keep reading it over and over and over again. And I did give another link. Let me see. Yeah, if you're really tired of this one, because there's also Trading in the Zone. Read that book. Trading in the Zone, very good book. You guys should read that book. I mean, you can find it for free. I won't tell you where to go find it for free, but yes, you can read that book too. Let me try to find that link I gave back in wherever. Man, I'll never find it now. Let me see. Blah, blah, blah. Wonder how I'll find it. Yeah, Trading the Zone. That's the book. Yeah, but today we're going to discuss something else, which will preface another thing I'll talk about. And let me see. How do I find that book? Wyckoff. Free materials. I think it was this one. Yep. So I found the link. Here you are. There you go. Here's the free trading resources. You can go get that. So if you're tired of reading that PDF over and over again, you can read that. But today we are going to talk about something similar to Wyckoff. But, I give you a little. Once you learn this way, you can use it to look at sectors automatically, because this dude created his own website. So this is a nice little tool to look at sectors. So this is the PDF. I keep telling people to read The Anatomy of a Trading Range by Jim Forte. That's it. And this is the trading website where you get the stuff for free. I think this is one of the websites where you get for free. I think there was another one I gave. I keep forgetting because I had another one. I guess I put it in my phone or something. It's probably somewhere else. Here, let me find it for you guys, because I gave it last week. So make sure I can. I'll give it to you guys again. Here we go. Here, let me find it. Wyckoff. Okie dokie, Squarespace. Training resources. All right. Here, this is the one I was telling you to go. This is their old website, so they have some things in there that the other one doesn't have. Okay, so the wyckoff.squarespace.com. There you go. You can go to that one. So you'll see the difference here. Okay, so you got this. Yeah. So you got about the same things, but there's a few differences, all right? So you can go down through here and, yeah, you don't need to go through these books. I mean, you can if you want them, but no, not necessary. I don't think you need to read too much to get the feel of things. But if you have time, yeah, go ahead. But definitely not necessary. So what I want to talk about today is a stage analyzer screener. This is really neat. Okay, very neat. And let's look at what these actually mean. What is a stage analysis analyzer? So this is what it is. Stage analysis is a strategy for longer-term trend trading. It was discussed in detail by Stan Weinstein in the book Secrets for Profiting in Bull and Bear Markets. Stage analysis uses chart patterns to describe 4 distinct stages that a particular trade can be in. The stage and transitions between stages have specific guidelines for whether a trader should buy, sell, or hold the trade. This creates a simple strategy to follow when trading the market. Stage analysis helps traders identify and stay invested in the long-term trends in the market. So the key components of stage analysis: weekly stock chart. Weekly charts are used in stage analysis since the system is designed for longer-term trading from weeks to months to years at a time. A stage analysis is definitely not a system for day trading. 30-week moving average. The price action on the weekly chart is compared to in relation to the 30-week moving average in order to determine the specific stage in stage analysis. Whether the weekly price and the 30-week moving average are trending higher, lower, or sideways determines the specific stage. Volume, a key component of the transition from stage 1 base to stage 2 advance, is big increase in volume on a breakout. All right. So, I mean, let's just look at the diagram. Let's look at the diagram. I think you guys got the idea. So essentially, very basic system. We got a 30-week moving average. We're looking at a long-term chart, and we could see like, oh, there's got to be these stages, right? Very simplistic. Now, I will show you how this notion that stage analysis is definitely not a system for day trading isn't technically going to be true in the next video. But for now, let's just assume this is only good for long-term trading. Okay, and we have these multiple stages here. 1, 2, 3, 4. So if we can identify what stages are we in, you know, we could roughly assume when to start buying a stock or getting out of a stock, right? That's the theory. So here we go. We got this nice little tool, this screener. And we can look at different sectors here. You got auto parts, advertising agencies, cannabis, conglomerates, copper, discount stores, electronics, gaming, and multimedia. So we got tons of sectors here. So we're interested in looking at the beginning of a trend, right? So let's look at stage 2. Let's sort everything by stage 2. So we want to find stuff that's early stage 2 and then look at, all right, well, another way is to look at stage 1, but yeah, I'm just going to focus on stage 2. Let's look at stage 2. Let's see which ones are like in early stage 2. So probably about 30% would be like early. And we want to have a lot of it still stuck in stage 1. So if you look at uranium, lithium, they're above 50% stage 1, 20% stage 2. So lithium and uranium might be the sectors that we want to start investing in. They're early in the stages, right? So this is what's really nice about this tool. See what else we got. Anything that recreational vehicles, RVs, really? Could they be? I don't know what RV stocks we have here. Which ones? Oh man, maybe instead of the Thorpes buying RVs, they should have bought RV stocks. Maybe this is how you're gonna get rich. In any case, let's see what else we got. What else do we have here? Airlines. Oh, I see. Airlines could possibly, but you know how I hate airlines. I don't know. I don't like that 50% on that one. So let's see what else. No, nothing eye popping to me or so far. Home improvement, yeah, that's kind of already gotten well into stage 2. So yeah, there's some things that you can catch with this methodology. I think it's pretty interesting. But a lot of things are already well into stage 2, as you can see here. Many things are already starting to get into stage 2. So that's why I think based on this, next year should be pretty easy to pump the rest of the way up for at least about half a year to a year. So many of these stocks that are well into stage 2, so these sectors here, yeah, I think would be quite easy to get further momentum going. And then that's what we have to be careful, because like what are these? They're going to start seeing signs of being in stage 3. We have to worry about building materials, 21% stage 3. Yeah, that could be the, yeah, real estate did have an early pump. Crypto miners, no, not yet. Crypto miners are kind of like the way this looks right now. Probably the stage analysis isn't perfect for them. It's kind of too spread out between all the stages it's detecting. So yeah, I don't know how well the scanner works for most sectors, but it is a nice thing to pay attention to. I think this can filter out a lot of things you're gonna do, and I'm gonna use stock charts to try to filter out a lot of stocks. So this kind of gives you an idea of where I want to approach. I'm gonna start having something that'll automatically scan for stocks, sectors, rank them in a way just like this, and see where we should focus our attention and our capital in. I think that's where we want to be. So the stage analysis type thing here is a good template. It's a good idea. It gives you some ideas. It's quite simplistic though, very simplistic. Now I'm going to give you something more advanced. Hopefully you won't freak out a little bit. But it takes that simple idea of the stages and puts it in multiple time frames. So let's see if you can figure it out.
This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. This is Joe Rabel. So what I'm going to do today, I want to basically give you an idea why I started the channel originally, which is I wanted to give people a better idea of how to be their own analysts. And what I'm going to do is I'm going to show you sort of the basics of my approach and how we can use trend and momentum to, I think, give us a real good idea of how to analyze the market and figure out stock by stock, index by index, right? Where things are situated. And I think it can make you a better investor. All right, let's go ahead and get going now. A lot of these techniques are in my book, and we're going to talk about both trend and momentum. You can learn more about these in this book at rabelstockresearch.com/book. Also, if you do enjoy the content, please hit that like button and also subscribe. So we want to start with the basics. And, if you learn technical analysis from anybody, you should be learning this concept of these 4 stages.
Looks familiar, doesn't it?
Okay. And so it's more of a universal truth. It's not something that, one person uses this idea and someone else's doesn't. I think if you're going to understand the basics, you got to first understand that a stock will go through a basing stage or an accumulation phase. Okay. And then once we get enough strength in the buyers to turn this accumulation phase into a uptrend, we break out, we get some upside follow through, and then we'll trend to the upside until investors believe that we've made too big of a move and it's a time to start taking some profits. And then we start forming this topping phase. Okay. And then when the sellers are stronger than the buyers, then we actually turn the actual pattern down to a downtrend. Okay. And then we start the process all over again. Now, I'm not giving you that much detail into the thought process of each one of these. And the reason is that I want to explain the approach that I use is that this happens in every time frame. So this could be happening on a weekly chart, but it also could be happening on a 10-minute chart. Okay. And it could be happening. So we could be in an uptrend on the weekly, and we could be in a basing stage or stage one, on the 10-minute, okay? Or we could be in a topping phase on the 10-minute. We could also have a daily chart in a topping phase while the weekly is in an uptrend or a downtrend, okay? So you have to understand how the market works and flows in multiple time frames. So that's kind of the key, I think, in terms of learning the basics, okay? Now, if we move on, I do want to give this explanation, and this sort of takes it to the next step. And what we're looking at is, and now I'm only giving you half of this stage. So this would be the topping stage. Stage 3 is the topping phase where you top out, and then you go through a downtrend. This is stage 4, and then you start the new basing stage. That's stage 1. Okay. And then here is where you start stage 2, where you start to come out of this basing phase and start a new uptrend. All right. Now, if you notice, the way I have drawn this is we can see on the the higher time frame. So let's just make this simple. Let's say this is a weekly chart, and what I'm showing you here with the blue line and the price action is the daily. All right. So the weekly chart is actually in an uptrend, and we come down in a corrective pattern, and we go through the 4 stages, and then we emerge out of that. And what we're looking for, this is a stage 2 uptrend, and we're looking for a match. We want stage 2 in 2 consecutive time frames. Now, what you can do if you have the right momentum conditions in place is buy stage 1 in anticipation of stage 2. This is the crux of my approach, and that is understanding the lower time frame triggers. All right. If we know we're in an uptrend on the higher time frame and everything's looking fine, and we come down and we don't have that much strength in the decline phase based on the momentum conditions. Now, I'm not showing that on here, but we want to watch the momentum conditions using MACD and using ADX in all these time frames, especially in the time frame that is going through the 4 stages. If we come down into this area and we see a shift taking place, or we see no real strength in the sellers, then we can go down to this time using this time frame and go and look for price and look for and try and enter the reversal pattern, breaking the downtrend, coming back and testing. And if we get a test that looks good, we can buy the 2 and the higher low of the 2 before it turns into a new uptrend. Now, the 2 here is a little different than what I'm talking about with the stage 2. This is actually a 1, 2, 3 reversal, and the 2 is the test of the low as opposed to waiting for the trend to turn to the upside. This is where we'd be in a stage 2 uptrend, is buying it kind of on the 4 after, the 3 makes a move, we turn back up, and then we make another higher low. So I'm telling you is that if we have the right momentum conditions in place, we can buy inside the 1 using this 1, 2, 3 reversal.
All right. Did that confuse you guys enough? That probably confused the hell out of you guys. But there's a lot of concepts he just threw at you in this brief moment of explanation. So you had like the idea of the stages I brought up earlier. Then you have these trend line, like trend idea, where you do multiple time frames, where you try to look at the stages at a lower time frame and then look at what stage something is in a higher time frame. And then with this 1, 2, 3 thing he did down there, everything does move in a 1, 2, 3. That's kind of like the ABC pattern. That's something you'll see in fractals all the time. So when, yes, everything is fractal. Everything you'll see repeat again and again. And yeah, you might not get it now, but I think this video really encapsulates a lot of the things you got to be seeing naturally, intuitively, after you look at charts for quite a while.
All right. Now, when we want to do this, are these areas I'm showing you over here. This is where we're coming into the zone between the 18 and the 40. You see these spots where we're looking at pullbacks to rising 18 above a rising 40 with good momentum condition behind it. All right. Now, if we have that, then we can look to play these pullbacks and use with good momentum, right? Modest momentum to the downside, strong momentum to the upside, modest momentum to the downside, and then use our price pattern reversals to get us in at the turns. All right. So that should help us be able to identify when to enter during these pullbacks, these bigger picture pullbacks. All right. So what we're trying to do overall is look for a situation where we get long-term uptrend with good momentum conditions in place. Now, I'm not drawing these, but we've got MACD and ADX both confirming the trend to the upside. Preferably, we have the 18 and the 40 rising at about the same rate. They don't have to be parallel, but we want them kind of looking like that. All right. So that's our starting point. And then the second stage is we have a stock that is correcting on the next lower time frame. Again, if this is the weekly chart, then on the daily chart, we're watching it correct, and we're looking for a reversal on this time frame. Okay. And if the momentum on the lower time frame, now this is the upper time frame, but if we can do the MACD and the ADX on the lower time frame, and all of this is this is explained in the book, but it's really in detail. I go through this in the course and or the courses. And if we have this reversal, right, then with the right kind of momentum in place, then we can get in when we can get our match. We can get a stage 2 and stage 2, but we can buy it before the smaller time frame, the lower time frame becomes a stage 2. All right, we can anticipate a little bit because we know we've got the upper time frame in our favor, and we know that the momentum on the lower time frame is also in our favor for upside continuation. All right, so that's what we're trying to identify. Now, I'm going to give you just a few examples, and I want to show you. So I did this on purpose. I've got on the bottom, I've got the quarterly chart of the QQQ in the bottom left. All right, in the bottom right, I've got the monthly chart. All right, now in the upper right, I've got a 10-minute. And then in the upper left, I've got a 2-minute. I wanted to show how this is universal based on time frames, meaning if I can put 2 time frames side by side, I can read the market. I can see what's happening. I've got pullback to the rising moving averages on a quarterly chart. See that? We've pulled back exactly like what I was showing. Now, here's where you're getting this lower high, lower low on this time frame. Now, in this instance, we broke the downtrend line and we didn't get that higher low until way over here in this turn, but we had the MACD. You see how the MACD held the 0 line, and that the sellers had no real strength behind it. So having that in place allows us to play this. Now, obviously, with a monthly chart.
So this goes into more advanced concepts. You guys still don't know about MACD. I haven't taught you guys that, and definitely not ADX, which goes even further. So I'm not going to continue on now, but I'm going to play another video because we're going to talk about Uber. I think that's pretty relevant with how Uber is doing. It is quite a good chart right now since Tesla kind of pumped it. And with the transportation index also going up. Yes, that is something that we should pay attention to as a stock. So let me try to get it for you guys. Here we go.
This channel is for education.
So let's do this.
Means we have to
forward to this
off or left. All right. Now I know that some of my subscribers took advantage of this because I got some emails on it and some commentary in our community. So what I wanted to point out here is we're looking at three different keys. All right. There's the initial thrust off of a move or a breakout play or a continuation signal. Then there's the pullback. Okay. And then there's the trigger. Those are the three keys we got to be on the lookout for, and they have to kind of meet certain criteria. The hardest part of trading, in my opinion, is the pullback. Okay. Every pullback is a little bit different. Every pullback has a little bit more different level of strength to it. And that means we have to identify what is the best course of action for a trigger. All right. Now we can find a lot of stocks that do this. This is the monthly chart. Look at the strength behind this move. You see this up leg started at the 18-month in the middle of 2023, made this thrust to the upside, very strong confirmation in MACD. Powerful confirmation in the ADX with green DI on top, breaking out, showing the buyers are very strong, causing this ADX to rise, well above the 25-30 level. All right. Then we go through our correction phase. Now or a pullback phase or correction, whatever you want to call it. Now on a monthly chart, it's a pullback. On the weekly chart, it's an ABC correction. We need to be able to identify the strength of this part.
Yeah, you heard that, ABC correction. So yeah, I mean, yeah, he kind of takes for granted, like that's why he's trying to do that 1, 2, 3 thing, like in the previous video.
Yeah. 2. The problem is, so we can identify this on the up move, and we want to look at it on the higher time. We want to identify the strength on the higher time frame on the up move, the up thrust. Okay, but on the pullback, because these indicators, MACD and ADX, have lag to them. All right, they're not going to be as quick to identify weakness or strength in the sellers on a pullback. We have to go to the smaller time frame to identify this. All right. So we look at the strength of the up move based on the higher time frame. So if this is a 2 time frame trade, this is the higher time frame, this is the lower time frame, 2 time frames. All right. Now we can go down to the micro in this. I'd call it micro because this is higher or lower, and then this would be the next lower time frame. So you could call it next lower, right? And if you're doing a trade off a weekly, daily, then the next higher would be the upper time frame would be the monthly. But let's just keep this simple. We're doing a monthly, weekly, and then we can use the daily to refine our entry. Now, what I know is I got a few guys that did the monthly, weekly version of this trade, and I think there were some that did the weekly, daily combination. All right. Now, I'm going to focus mostly on the monthly, weekly, because I just want you to understand the combination of events that need to take place and how disciplined you need to be and how much patience you have to have. We have an up move with strength, and then we go to the pullback. Now, during the pullback, we need to identify how much strength is in this correction. Now, the way we go about doing that, and I'm going to expand this so you can see. First thing we want to do is watch the strength of the sellers. So when we're declining, that is the red DI. The red DI is telling you the strength of the sellers. The first thing you want to be on the lookout for is, does the red cross above 25? All right, this gray line going across here is the 25 line. Now, if you notice, we went through a big decline. It went from $82, dropped down to what, 60, low 60s, mid 60s, rallied up, and then came back down to the mid 50s. So we're talking about a move from, low 80s down to mid 50s. And red DI, the strength of the sellers, could not even get above 25. This was the peak in the red DI during this decline. This is pretty violent negative DI. This is all negative DI, this big drop. Even, well, no, this doesn't count, but the rest of these would be negative DI, and you couldn't get this to cross above 25. So that's the first order of business that I do, is I look and see how strong are the sellers. Because if this breaks out and does this, then I want to watch and see if the ADX follows suit and crosses back above the 25 line. If that happens, then I know I need to be a lot more patient with this entry. I don't need to be in a big rush. All right. But in this case, it did not happen. We had the ABC decline. We came down and red DI could not do that. And we had a low ADX condition where it was below 25, and the red DI was below 25 as well. It failed at 25. All right. Now, the second order of business, so what that tells me, so what I know right now is that the buyers are clearly still in command. We've gone from 82 to 55, so we've had a big drop, yet the bias is still positive based on what I'm seeing in this lower time frame ADX signal. Okay, this is huge information. All right, you're getting a massive advantage over everyone else. Everyone else is looking at this, especially through this decline here, and saying, God, this is breaking down. It looks like it's actually rolling over. Looks like it just broke the trend line, rolled over, turned down, right? But we know that the higher time frame's in an uptrend, so we're thinking the other way. But more importantly, we know that the sellers aren't as strong as you think they are. Now, the other thing we want to figure out is the velocity of the decline. All right. That means how steep these moves are. Not necessarily. We know that the sellers have been the stronger of the two during the decline, but we don't know how severe the slope of the move and the strength of the move has been. That's where the MACD comes in. So the MACD only made it back to the 0 line. All right, here's the 0 line. And we went through, again, a pretty severe corrective pattern. And all we did was work off the overbought condition. We were way overbought up here. And then we came back down to the 0 line. Now, if this line crosses below and the red line, the signal line crosses below, then we know we probably, again, we need to be a little bit more patient. Now, that's a little different than the red taking over, because in this situation, we have enough strength in the buyers that we know the bias is to the upside. Okay, so this is more about timing. This is the MACD is giving us help with the timing. This is telling us whether we want to do it or not, because if red takes over and shows strength, then it's almost like we probably want to put this on hold for a while until we see green come back again. And most of the time when you see red take over causing the ADX to move up, it takes a long time to get things back up and going again. And it might not really ever trigger when that happens. But when it plays out this way, where we don't have any strength in the sellers and the MACD just comes back down to the 0 line, we need to be ready to go on the first sign of a trigger. All right, so let's just review real quick before we go to the trigger. So we have the strength on the upside confirmed by MACD and ADX on the higher time frame. All right, and then we have the ABC correction confirmed by the lack of strength in the sellers on the decline phase. Strength on the up phase, lack of strength in the sellers on the down phase. So we have the two components that are incredibly important to identifying a setup situation. We have a setup. All right. Now, if anyone who wants to know a lot more detail on the trigger side, because this came down to the 0 line and held, and we have an ABC correction, we can draw a trend line in. Now, these rules are it's not that simple. We need to know the rules, and that's where the course comes in. I go into detail in the first course, the advanced trend and momentum course goes into detail on all that. All right, so we have this trend line. So you have the option to take that. Now, one of the things that we talked about in the video and in our live webinar and that kind of thing was how important this 85 level was. So coming up through 85 could have easily been your trigger. Your trend line would have also been worth considering, even though it had already made a pretty big move. I don't really like that as much. So usually I'm waiting for a higher low to form or a pullback or something like that. Nonetheless, we had one trigger could have been taking the trend line break. I mean, it is a signal. It's definitely a signal. Now, because it was up so much, I might not have taken that. I might have waited for that higher low to form. That could have been your second option, second trigger. Third potential trigger would have been coming up through 85. And then actually your fourth, and as I said, we had some guys that took advantage of the higher low. That's where the RSI comes into play as a additional trigger using the daily after a kind of like a breakout play on the weekly. So we have all three components. We have the option to play it off the weekly chart. We have the option to play it off the daily chart. And then it's just a matter of from here, most guys have already taken a partial profit. All right, we've got the gap up. We got a partial profit in place. And what I've been telling my subscribers to do in the volatility that we've had is to go ahead and put it at a break even. Depending on what your entry was, you go to a break even and sit back and see if the market allows this to turn into a big winner. That is all we're looking for. We don't know. There's no way of knowing which of these stocks are going to turn into big winners. That's why I suggest being very disciplined about your exit strategy and not trying to be a hero and saying, hey, I'm getting out because I think this is the end of the road or the market's going to turn down or anything like that. You just don't know. It's possible. Trust me, I spent 3, 4, 5 years studying exits and tried to be the perfect exit guy. And what I found was we're a lot better off being disciplined and consistent with our exit strategy, and it really helps our equity line look a lot more consistent. This is what I want your equity line to look like, right? We don't want it to go like this and then this. We don't want the big jagged moves. So in order to do that, you take partial profits, you raise your stop, and you have an exit strategy that's consistent and disciplined. All right. So hopefully this helps. Let me know if you have.
So I think that gives you kind of a preview of where you want to be as an advanced trader. I don't think you need to be at this level yet, but I'm a sloppy person, so I trade pretty sloppily. But if you want to be at the level where you really want to time things properly and make sure you get, you choose the right entries for that risk profit level. Yes, you got to be more like this guy right here. So this is Joe Rabel. So I put his link up. You can watch his YouTube videos yourself. And he goes, if you watch enough of his videos, you pretty much understand what he's doing. And you don't need to pay for his courses. I mean, that's up to you. If you keep watching it over and over and practice it, you got like 90% of everything he teaches for free. But it takes a lot of work to do this multiple time frame type of work here. But it's very powerful. T Spells, when she was on to discuss trading with CKJ3, she mentioned multiple time frames. She said it was a confluence. She tried to look for confluences. This is what this guy's doing. You are trying to look for the best entry, looking at all these time frames, the lower, the higher, everything, and you are trying to maximize your chance of hitting a good trade. That's all you're doing. There's no guarantees. All you're trying to do is increase your chances that you will get the trade right. But this requires a lot of pattern recognition. You're going to have to be staring at charts all day. I don't really, think a lot of people are into that, but hey, some of you might get to this level. So I just introduce it out there for you guys because we will revisit it eventually. I have to teach you about MACD and ADX and all that first, but that's not too big a deal. Anyway, before we leave for tonight, I think I have one more topic. So John talked about alpha, okay, that excess return. So that's why there's a website called Seeking Alpha. We are always seeking a better return than what's possible, right? What's the norm? That's our goal. But what are the risks? The risks are measured in beta or beta if you're, UK, Australian. Here, let me show you. Let's go over to the Investopedia article because I like Investopedia. What beta? Beta means for investors. Okay, let's go. Let's see. What is beta? Beta is the second letter of the Greek alphabet. Oh, no shit. Used in finance to denote the volatility of or systematic risk of a security or portfolio compared to the market. Usually the S&P 500, which has a beta of 1.0. Stocks with betas higher than 1.0 are interpreted as more volatile than the S&P 500. Okay, let me put that link up for you guys so you guys can have fun on your own. Yes, you can read that Investopedia article on beta, and you can also look up alpha. So, how do we figure this out? Beta is a coefficient. Shows the volatility of an individual stock compares the systematic risk of entire market. Beta represents the slope of the line through a regression of data points. In finance, each point represents an individual stock returns against the market. Beta effectively describes activity of a security's returns as it responds to swings in the market. It is used in the capital asset pricing model, CAPM, which describes the relationship between systematic risk and expected return for assets. CAPM is used to price risky securities and to estimate the expected returns of assets, considering the risks of those assets and the cost of capital. Calculating beta. A security's beta is calculated by dividing the product of the covariance of the security's returns and the market's returns by the variance of the market's returns over a specified period. The calculation helps investors understand whether a stock moves in the same direction as the rest of the market. It also provides insights into how volatile or how risky a stock is relative to the rest of the market. All right. Zoom out here so you get that nice equation. I don't think we're going into details of what variance and covariance is. I think Portia could teach you that one day. For the beta to provide useful insight, the market uses a benchmark. Should be related to the stock. For example, a bond ETF's beta with the S&P 500 as the benchmark would not be helpful to an investor because bonds and stocks are too dissimilar. Okay, keep that in mind. Okay, let's go on. So beta equals 1 means the price activity correlates with the market. Adding a stock to a portfolio with a beta of 1 does not add any risk to the portfolio. Beta less than 1, a beta value less than 1 means the security is less volatile than the market. Including this stock in the portfolio makes it less risky. Beta greater than 1, a beta greater than 1 indicates that the security's price is theoretically more volatile than the market. If a stock's beta is 1.2, it is assumed to be 20% more volatile than the market. Okay, so what's negative beta? A negative beta means, let's say negative 1.0 means the stock is inversely correlated with the market benchmark. All right. Okay. Put options and inverse ETFs are designed to have negative betas. There are also a few industry groups like gold miners where negative beta is common. Oh, so you think gold miners will go opposite of the stock market? I see. So anyway. Yes, this you can read on your own. But remember, last week we started talking about average true range as a measure of volatility, right? We did that. So let's go back to the chart. Let's go back to the chart. And let's go back to the whipping boy I chose today, which was like SOXX. Semiconductor ETF now. HB, we're playing around with SOXL. SOXL is 3 times daily movement of SOX. Okay, so you see SOX here. SOXL is similar, but it moves 3 times that. Okay, each one has a 3x percentage move. So today we had these huge candles, negative 3%, negative 8%, negative 1.6%, negative 2.5%. So you're getting a large reaction. Okay, let's look at the beta then. How will we know the beta for these things? So if we could use the average true range, that's one way. I think you could use that. So let me see this tutorial. Yep. Let me get rid of this. So for SOX, let's do the daily chart. So the average true range is about 7. So $7, 7 points for SOX, SOXX. So today it dropped negative 12. Okay. So our average true range was around 7. So that means we could theoretically have dropped 7 and I wouldn't have been surprised. Dropping 12, yeah, that's a little bit more than expected. But overall, probably no surprise. Now, if you use SOX L, what's the average true range here? So it's about 3.5, 3.7. Okay, so today it dropped 6. So it dropped more, quite more than the average true range for this stock. Okay, so let's just say we had the average true range. Maybe we double it. So we do 2 times average true range here, and we'll do the same for SOX. SOX. So if it's about 7, so that's about 14, right? So that's close to negative 12 here. Okay, so if we do SOXX 14, let's say 14, and then the last closing price yesterday was about 240. Okay, so 240, right? So if the next day we drop 14 out of 240, that shouldn't have been a surprise. So that's about 6%, right? So and today we dropped 5%. Now if we did SOX L, so here we say it's about 3.5, right? 3.5 to 3.7. So let's say 3.6. So 3.6 times 2, right? Okay, so we got 7.2. And the last closing price for SOX L was 40.8. All right. And so that's about 17.6%. So today we dropped 15.5%. So yeah, that's within that volatility. So if we just look at that as a way of gauging some kind of form of beta, you shouldn't have been surprised, because if we look at the S&P 500, which should have lower beta than either of those. So here, the average is true range is about, 6.5. Let's say 6.5. So double it up. That's 13, right? So last closing price for the S&P 500 ETF SPY is 584.3. Okay. Now we say 13 divided by 5 of this. So that's about 2.2%. So that has quite a lower beta than either SOXX and XOXL. So we shouldn't be surprised. And that's the risk. So that's why I introduced those concepts last week. That is your risk. Your risk is your volatility. Okay, you have to measure the risk. So not only just looking at the gains, because yes, SOX L is amazing when you're on the right side of it, because that's why I said, if you bought it here, here, and you sold here, and you sold here, you're great. But if I bought here on Friday and I was trapped in this range, right? Because look, I'm in that rectangle. That's not a good place to buy. That's the problem. You're taking a risk, and your average true range is in that rectangle here, right? Because let's look at SOX. That's the rectangle. That's the rectangle. You're in it. So that average true range, that volatility, this red candle could easily, if I bought in here, anywhere in here, I could lose it all. Or if I was really dumb and I just bought right at the top of that rectangle, yes, I'm all the way in the red right now. I'm down 15%. right? If I use SoxL right now, if I bought right here yesterday at the close, I'm down 15.5%. That's huge, huge. So that's the risk. So everybody always likes to look at, oh, what's the potential gains? But they never look at the risk. The risk. What is your risk and reward? It really depends on where your entry is and where you expect your resistance and support levels are. That's why you look at charts. Charts, we're not using it to I'm not using it to predict anything. I'm just using it to well, what's my chances of getting somewhere here in a gain without losing my ass? It's a lot better buying down here than up here where everybody was fighting since March. So that's what I'm trying to, get at. We're not using this to predict stuff. And I know a lot of people use technical analysis. They go oh yeah, I see a pattern. I see a cloud pattern. I see this. Oh, it's going to do this, going to do that, jump up and down. Yeah, whatever. No. It's not a crystal ball. All it is just telling you what my chances are. I'm just trying to use it to have odds here. And, it does work pretty well for that purpose, I think. So there you go. I think that's pretty good lesson for today. That will wrap up everything I taught last week into this week. And I think this was a great example to show you how news is kind of used as a weapon against retail. Because I'm sure somebody knew all that was going to happen, and somebody leaked it a day early to spook everyone. Yeah, before we actually have real earnings. And we will have earnings. So let me show you again what the earnings are that are left that are important for me, in my opinion, anyway. Okay, finally. I think StreamYards is starting to slow down like crazy. Third hour. So you see that TSMC before open. So it's going to be early in the morning, Taiwanese time. Thursday, we have TSMC. That's the next big semiconductor since we already got leaked on ASML. So whatever they're going to say tomorrow morning can't be worse than what happened today. So we're still waiting Thursday morning. And then after that, we got Netflix. That's the first big NASDAQ earnings that people are waiting for. They got to see a good consumer. The consumer must consume. So you better see it. So that's what we got to wait for on Thursday. And then after that, we got to do next week. So let's just get it 1 week at a time now. Got that. And I'll give you this website to check out. I think I like this website. This website's pretty dang cool. It has a beta calculator. So you can calculate your own beta using this. I think you got to sign up to get all the full features. I haven't checked it out like that. But for what I see without getting an account, it looks pretty good. So here I made up a portfolio here with 20 Bitcoin and 100 Axon shares, 1,000 Palantir shares, no S&P 500 shares. So, you can goof around and make your own portfolio and see what the beta is for it. So yeah, it's not bad. I had like 100 S&P 500 shares. And I do 1 Bitcoin. So I reduce my Bitcoin. Let's recalculate. Okay, everything's evenly distributed about approximately. So yeah, so my 3-month beta is 1.4. My 6-month beta is 1.4. 1 year beta is 1.25. Yeah, so not bad. That looks pretty balanced. Not too risky, is it? Maybe 20% risky, but not that much risky. So let's say I have like 500 S&P 500 shares. Maybe I just like have 0.5 Bitcoin. Let's see what happens here. Yeah, you see that? Once I stuff everything with like S&P 500, I get closer to 1. There you go. So if I'm more risky, I just put this back at like 100, and I put my Bitcoin holdings to like 30 or something like that. Let's see. Yeah, you see my 3-month beta went up to 1.85 and 6-month beta to 1.77. It's interesting that the 1 year ain't that bad. It's 1.11. So over 1 year, my volatility isn't too bad. So, but if you just did a 6-month window or a 3-month window, yeah, it looks pretty crazy thanks to Bitcoin. But if you average it out over the year, like most of this year, Bitcoin hasn't done much outside of its range, you know. So definitely something to look at. Actually, yeah, I should check out Bitcoin before I go. I think it just hit like 67,000 today. So yes, I'm quite curious if it can hit 72 and see how it reacts to 72,000, because that's like the all-time high, I believe. And if it drops back or not from there. And if it does pull back from there, get ready, guys. Get ready. It's Bitcoin miner season again. This is the easy money. And if you like options, yeah, you can go get some calls on coin miners and be a degenerate gambler. Go ahead. Go ahead. No problem with me. I think it's worth a gamble. Yes, we are at 67,300. I see it. Let's put it up on the screen. Not bad, not bad. We are at the top of this rectangle that I drew. Let's see if we can hit 72-ish. Yes, yes, yes. So my expectation is that we're going to try to fight above this rectangle for quite a bit. So maybe a little bit above. But I think we'll pull back again to 65, maybe just one last time. And if I see that, yes, that's a strong case. Well, like the first quarter, probably first quarter will be quite amazing. And the two stocks I like to use is Mara. It's been dancing around here. So here I got in Mara like October. So when it was like $7 to $8, and then rallied all the way to 30. So I sold as it went up there. So you got 8 to 30 move. And if you did options, yes, you know what that means. CLSK is $3 to $4. And then I sold one chunk when I got to about over 10. Yeah, and then I waited to sell my second half here. So this one's a little bit more janky. Definitely a lot more janky right here. And now we have the distribution area. We're now dropped here. And you see here we have a little base. Got a little base here. And we're trying to break out of it. So a lot of good looking stuff. Michael Saylor, that's another Bitcoin proxy stock. So we went over the last high of March. Now we're pulling back. Let's see where we stay here. You can also get calls on that one. I don't know what's cheaper in the options world right now. I don't know if MSTR options are cheaper than Mara or CLSK. So that's up to you. You got to, guys, investigate it if you're playing with options. But yeah, those are the types of stocks you want to get into if you want to play stocks for Bitcoin. Otherwise, you can just play with Bitcoin directly. Bitcoin has futures, they have options. So Bitcoin itself has that. And you also know you have the other coins, the altcoins. Once I think Bitcoin makes its move into the first quarter, yes, there'll be another repeat fun of Dogecoin, Shiba Inu and all the other crap that will come along with it. Who knows? Solana is definitely one to look at. I like Solana. So yeah, there are probably others, but you guys will have to recommend it to me. I wish we had time to make a John Galt coin for this point, but some of us need to, get on it. I don't think it's as easy as I thought to do a REIT with it. It's definitely easy to make a shit coin that does nothing, but actually making a coin that does something, yeah, it requires a little bit more work. So we'll see. Maybe some other time down the road. All right, guys. This is 10:45 p.m. my time, so it's time to go Betty bye, and I'll see you tomorrow when the markets are gonna go crazy once again. I'm sure in the morning. All righty. Good night.